expecting and looking for, that's where it's going to draw
We're on the paintbrush and cutting the grass episode.
to. Just like when you're sitting down to figure out when you're.
Yeah, it's gonna be a good backtesting session, and honestly, we're just gonna lead. We're gonna backtest for a while, and then lead into a tapering session, and then we're gonna end it there probably early. But yeah, we got the graveyard shift tonight.
Cut the lawn. When you start making that mower pass over top your lawn, you know you got to keep doing it until you get to the end of the lawn. Well, the end of the lawn is down here, so you got to keep constantly doing what? Apply the paint to the wall, or keep pushing that mower until it goes to completion. The completion is time and price. So we're in that last hour of trading, 3 o'clock hour. The market's delivering into our objectives. The one I gave you on Twitter, we already hit it, and it went past it. That's fine. But when it goes up into this level here, you're anticipating it to do what?
Showing how about y'all?
Never go back up here. It has no need to do that. But what can it do? What's permissible? It can go back inside this fair value gap. Because why? This is an old inefficiency in price. Whereas this, the difference between this candle's low and this candle's high here, this is efficient. What makes it efficient? It's traded both directions in between this candle's low and this candle's high. So price is effectively permitting balance in order flow in price delivery. Price delivery is every time there's a new price tick and there's a new fluctuation in price action, that's delivery. That's the market being presented a new valuation on an asset. So what we're doing is we're measuring.
I kind of want to. I haven't really looked at the charts. I guess we'll see. Most of my. Sorry, I know. I was trying to watch this. I do want to look at the charts real quick. And I mean, all depends. This is YM. I definitely need to see what overnight session does. 100%. I'm honestly expecting consolidation. I'm expecting consolidation. It's on Monday too. Oh, look at that pricing right there. Right to constantly encroachment of this imbalance. I'm expecting consolidation. I would lean more towards wanting this fair value gap to get traded into though, because we've taken this high. We have SMT. I mean, this is going to be pretty difficult to pass through. I don't expect to see like one big pass up into there tomorrow. It also depends what overnight session does. But that looks like some nice delivery. We gapped up. I've been expecting, or I am expecting consolidation within this range. That's what I'm expecting to see. There's a lot of stuff on my chart right now. On NQ especially. I'm gonna. It's a nice, well, not a nice sell model, but we just completed this market maker sell model. And now I'm just expecting to see consolidation. How do you play the... Me, I use it as like a support and resistance level. I don't really have too much conviction with using it like off of open, but... Alright, let's get back to the video.
How often that delivery of price, how many times within a range specific to time, which is these two specific candles here, how many times has it passed through the same range of a specific number of prices? Meaning that this candle's high here comes in at 41.18 and a quarter, 0.25. And this candle's low here comes in at 41.16.75. So between those two price points, price went down, and then this candle here opened, went up, and then went down again. So this entire range between candle high and candle low is balanced. It can go back up into the midpoint of that. That's normal. I allow for that. In my analysis, when I'm reading price, I allow for it to go up to halfway. It's rare that it will go all the way back up to the top of a balanced price range. It can. It just means that I'm probably getting ready to bail on the trade if I'm using that as a point of interest to measure if these PD arrays are able to stave off an advance or a retracement against my trade. So I'm treating these PD arrays like you are being taught to use support and resistance, but never get them to work right. Whereas the algorithm is going to go into these specific little signatures and price action that cannot be hidden from you. It can't hide it from you, folks. That should be exciting. It's not like they're going to be able to go out there tomorrow and turn off candlesticks. We all, look, are you going to stop using a clock? Raise your hand in the audience right now if you're going to say, the hell with this. I'm not using a clock. I'm getting rid of my watches. I'm never going to look at the time anymore. That's absurd.
That's true.
And that's the first primary function of what price does. It follows time.
Price follows time.
It does things at specific times. Then it delivers price based on the efficiency and the price delivery continuum. It has to continuously offer fair value. If the market runs too quick one direction and it goes down like it does here in this one candle, is it fair? And that's probably not the best term of using for describing this, but for the sake of making it easy to understand, because fairness is not really the goal here for these markets. But if the market drops down like this and leaves this little separation between this candle's low and this candle's high, there was no overlap, no other candle after this candle closes, no other candle printed within the price range between this candle's high and that candle's low, in between these three candles. It's that small little segment of price action creates that little pocket, the little porous price action hole. It needs to be filled in. Okay? Think of it like a pothole on the road. Okay? You're going down the road, hey, boom, you just blew out your front end alignment. You're going to call the state, hey, you so-and-sos, I just tore my thing up. Well, where is that? What mile marker? Let me go back. I got to drive back up to it. There's the mile marker, and then there it is. Silly little analogies, but I use these types of things to teach my kids, and I tried to explain every possible scenario with my wife, and I still haven't figured out an analogy where it makes sense to her. She just thinks it's a video game, so whatever. But the fair value gap can be revisited entirely, and that's what we see here. Notice that these wicks trade up into that same old inefficiency, hits it here, hits it here. All this is a reclaimed fair value gap. Reclaimed means it simply went back to it and treating it as you would expect a resistance level to be respecting. If it's going to go lower, it's going to do what? It's going to go up, fail, go up, reject it, and send it lower. Wonderful. Wonderful. That's exactly what you want to see. You want to see that. You should not be freaking out when the market's rallying up back to these areas here, because we have this behind it, this balanced price range. This is kind of like the defender. Okay, it's the linebacker of price action. It's saying you can only go so far, Jack. You're not getting through me. It's the iron wall. Okay, you're saying no, can't get through me. So everything coming short of that or falling short of this. Hang on one second. I gotta fix these. This headset's really uncomfortable. So if we see any kind of retracements back up into a fair value gap, that's reasonable. And you're gonna see me explain this, and you're gonna see your experience seeing it happen. When I'm calling specific fair value gaps and it returns back to them, sometimes it'll go through them, like we were looking at this morning. There was nothing in there for a trade, nothing, until I saw one fair value gap when it retraded back. I said, okay, we're going to use the fair value gap again. I tried to take a trade on it, and it just wasn't working out for me, and I had to kill it, and I would have stopped out, and I mentioned it on Twitter, if I'd have held my full stop. That's human error. You're gonna do it wrong too. You're interpreting price and you're seeing objectives. I'm also trying to teach as well. But when you see these PD arrays, you're gonna learn their characteristics because you're looking at them. This is what's usually occurring when someone watches my videos. Number one, they're not interested in listening to someone really expound on the logic that's required to know how to do this. If you are lazy, and if this offends you, unsubscribe, don't ever watch me again, okay? Because this is for the people that really want to understand and learn. If you are lazy, you will not learn how to do this. There's no shortcut to it. You will go into charts, you will study, you will look at old data, you will back test, you will tape read for months and throughout this year, and that's how you get good at it. Here's who's going to fail. Pushing a button, getting into a trade, whether it's demo or live. You will not be able to learn this because you're not getting the same type of feedback and insight by looking at these things I'm calling out on Twitter, or when I reference it. Like, I just did it again in front of you here again today. Were you all here? I mean, did you see me not say, watch this volume imbalance here? And look what happens. It goes right up there, and it perfectly delivers to this candle's. What's the closing price on that candle? You're going to look right here, okay? This candle's closing price is 4111.75. I told you, watch this volume imbalance. It trades up into here. What's the high of that candle here? 4111.75. Perfect. Perfect, folks. Please don't come to me with this Mickey Mouse shit, supply and demand. It's nothing like that. It's nothing like that. When students sit down with me, and when I was doing one-on-ones in the late 90s, when I sat down with them and I was doing this with the bond chart and I would do it with the S&P, you should see their face. I mean, it's probably what your face looks like too when you're seeing it live and you watch it happen. You're looking around the room like, am I supposed to know this? Like, you're waiting for the knock on the door, like Men in Black are showing up, because it shouldn't be this perfect, right? But yet it should. If the markets were really designed for your betterment, it should be something like that. It's an investment, but they treat it like, let's turn it into casino. Let's turn it into a casino experience where they blind you by never having windows, never a clock, because they don't want you to know how much time you've wasted losing money. So how do they hide this stuff in plain sight? Indicators, baby. Indicators. And in case you don't like the indicators they've already pushed on the masses, they're always bringing what? A new round of indicators. They're already starting to do it with my stuff. Here's a fair value gap indicator. It's bullshit. It's bullshit. You're not even bringing in the most important criteria to that. You can have a fair value gap indicator. It's going to give you every single one of them. And you're going to look at that and think, what? It's overbought, oversold. It's overbought, oversold. And you're going to lose money. And you're going to say, oh, this ICT, he's a scammer. He can't ever do this live. He'll never live stream and call these moves. Doing it. And you're still plugging your ears and closing your eyes. The people that are learning, they're excited right now because they're seeing evidence. They're seeing a testimony every single day that the author is talking to you, baby. There's no denying it. So when you see these things repeat, like I mentioned here, the volume amounts, watch that volume amounts. I even facetiously said, oh, you're going to tell me that small little range? Yes. And what does it do? It overshoots it. So why? There's no mohawks in the lawn. Overshoots it a little bit, so it's seamless. Then it does what? Comes right back up. What's the close? I'm sorry, what's the low of this candle here that frames the high of the volume imbalance? I know, I love you too. You're sitting there thinking, I love this guy. Man, I love this guy. Yes, I love you too. This is going to be an amazing year. You should be thankful that you sat down and listened, because there's going to be a whole lot more of this fun shit. The low of this candle, 4109.25. Guy's thinking himself, how the hell did he just see that? I was thinking, I didn't say it out loud. He's in my head. What's the high of that candle? Got to be on the candle, just right one now. 4109.25. Exactly the low of that candle. 4109.25. Folks, listen. I took your attention on this live stream. It wasn't a tweet that got deleted that was incorrectly called. It wasn't something else. It was exactly that. And what did we have? We had unrealized objectives. 4101.25, which is this level here, and then the 4098.50 level, which I mentioned on Twitter. But it went further, ICT. Yeah, it's fine. I don't care. Do you hear any regret? Folks, if you know what I'm teaching you, and I know it, I don't worry about missing a move. The sun might not come up tomorrow. That's always a probability. It's not likely to be high probability, but the world could end. Anything could happen. I might go to meet my maker before I'm ready. Well, I'm always ready, but before I would expect to do it. Barring those extremes, if the market's going to open up tomorrow, I'm going to see these things occurring in price action. You're going to see them occurring. They cannot hide it from you. They can't. You should not worry about my algorithm being changed. It's not going to be changed, folks. If I honestly believed by sharing it openly like this, if it would somehow be changed or augmented, my flesh, the sinner in me would keep it to myself. And that's the honesty. That's truth. If you can't respect that, then, hit the road. But there's no reason for you to worry. You're wasting time worrying about stuff that has no bearing on your development. You're providing perfect excuses for you not to even start. Which gets back to one of the SoundClouds I did. Are you deserving? Because some of you probably don't believe that you are. And that's going to be an amazing barrier to you ever getting good at this. No matter who you learn from, whatever style or approach to trading, you don't want to fail. Deep-rooted fear of failing. So you'll make perfect excuses to justify why you're not going to try hard. I'm just never going to be able to do it. I won't be able to follow the rules. So why bother? I just might as well call it a scam. He's a scammer. He's never going to live stream. I'm doing it now. I'm calling it. I'm telling you on Twitter, and I'm telling you here. Come on. Wake up, man. You're going to burn through this whole entire year and waste this opportunity. So anyway. So now let's look at it through the lens of your trading model is, say, it's the last hour of the day. Okay, so it's like 3 o'clock to 4 o'clock New York local time. If that's what you're trying to do, you have to understand where the market's likely to go. Where's it trying to reach? What's the draw on liquidity? That's the number one thing as a trader I force on my students to learn. You may not be good at it quickly. And that's the reason why I teach that premise first. Because if you start working on that as your first hurdle, that's the first thing you're trying to learn, and you're doing it correctly, by time devotion doing it over and over again, the other skill sets which are very easy, which are entering, which sounds crazy because you heard me say multiple times now. My hard part about trading was what? Conquering the fear of getting in. Now my strength is getting in. Like I could have said all this stuff and been wrong. I'm on live stream. I'm out here without a safety net, and the market makers can hear and see me, and they know me. Do you see them crash in the market because I said it? No. Manual intervention is always a risk. That means something's going to happen that you didn't expect, some black swan event, and boom, market's just going to go crazy. I expect that in Forex soon. That's why I'm not trading Forex. I'm trying to be a good steward with this information and also be a good human being, because I feel that that's exactly what's about to happen. You are going to trade whatever you're going to trade. I understand that. But it would be unethical for me to know what I know and not warn you. And that's all I've done. So I have a clear conscience. If you choose to do those markets and you get burned, I don't want to hear or read an email from you. You should have told me, because I've said it multiple times. I think that we're going to see something similar to when the Euro and Swissy was depegged,
so
which is unbelievably.
If ES trades into a volume balance, NQ doesn't. Which one to use? I mean, I would use the one that had the reaction of a volume imbalance, because volume imbalances, they're telling.
Damaging.
Like, if price respects a volume imbalance, then we're likely going to continue to wherever that is.
I don't know when it's going to happen. I don't have a timeline for it, but I know it's soon. And I don't want to be in those markets where I could get hurt. I could very easily get hurt. And you could potentially get hurt too. That's not to say you can't lose money in this market too, because obviously you can. But the type of move that I think is going to happen in Forex is not going to be the same type of move that we would see in this. It might move in similar fashion, weak, big drop down, but not to the magnitude and speed and velocity of which like a depegging was when Euro and Swissy was depegged. If you don't know what I'm talking about, Google it and look at that chart. Nobody survived. Brokerages were shut down over that move. They were insolvent instantly, just like that. And you can't survive those kind of moves, folks. You just can't. So I tell you that so that way you can prepare yourself for it and not get yourself hurt. I think 4088 was the next level I had in my notes. I don't have them right here with me, but 4088 was the very, very last thing. And I didn't expect that really, to be honest with you. Today I was wanting to see it trade into it tomorrow. So we'll see 4088. Tom Hugar's probably thinking, damn it, I should have held it. Man, he had me rolling today. I've been listening to him for about a week and a half. Not every day. There's a couple days where I wasn't able to listen because I was doing other things. But he sounds like Arnold Schwarzenegger. To me, he sounds like Arnold Schwarzenegger. And usually sounds very sophisticated, very articulate, gentlemanly. Once in a while he gets a little animated, and today he really got animated, and I literally was pissing myself. I'm like laughing my ass off so much I was tearing. Like man, it was so funny. It was funny, and I'm not laughing at him. I was laughing with him. And if you listen to his presentation, he was actually referring to me because I mentioned how in the morning session the market was really shitty. It was crummy. It was hard to get dial on what it was doing, and then he saw that I don't know if he saw it or someone mentioned it to him, and he's like, oh yeah, you'd have to hear it to know it, but it was funny. It was really, really funny. Hang on here. What the hell was I doing here? 4088. What is 4088? A higher time frame chart, that'll help you. But if you're the last hour type trader, okay, you're not trying to.
This was a nice sell day. It's the 9th. Like, well, look at where we put a low in. Right at that new week opening gap. What are you saying, 4088? I'm guessing it's just the high of this candle. Order block.
Being there in the beginning of the day at 9:30. You're not trying to guess what the range is going to do and where's the Judas swing, how much is it going to move this far. It's outside your pay grade. You're not worrying about it. You have no concern about it. You're not going to panic about what you missed. You don't have any fear over it. You're going to wait into the afternoon. Okay, if you're going to be an afternoon session trader, okay, if that's the case, you're focusing on the market beginning at 1:30 throughout this time window here. We're going into the last hour, 4:30. I'm sorry, 4 to 4:15, and then the closing bell takes off. Ding, ding, ding. But it trades again still further till 5 o'clock, and then we close for an hour until 6 o'clock. There's a 4088 level. Now, to me, I would be done. If it was a rip through this, then good gracious, that's it's a huge move. But this would be it. This would where I would say this is the week. I'm sorry, this is the day range for me, and I would be content if I held anything over. I've had nothing taken off. Every bit of my position would absolutely be off right here, and I'd be content with it. I mean, who wouldn't be, right? But if you're looking at trading in the afternoon and you want to have a really small window to focus, and you just know there's going to be setups forming, it's during the 3 o'clock to 4 o'clock hour. And a lot of my students very much like this framework for trading, because number one, you're looking at a very small sample set of data. It's concise. It's encapsulated inside of 60 minutes, and it allows you to go in and have the benefit of what has already happened in the day. Kind of like when I'm teaching Forex, I teach folks to focus on the New York session because they have the added benefit of having London behind them. And if they know where the market's likely to go in a higher time frame chart, they have all that guesswork of where's the high or low of the day, because most of the time it's formed in London. And then you can just trade in concert with that unfolding bias, leading to a higher time frame draw on liquidity, and not have to worry about getting whipsawed with getting in too soon and guessing where the high and low forms in London. Well, you have that similar advantage, if I can be permitted to use that term here. You have that advantage with the last hour trading because it allows you to have all of the hindsight perfect 2020 behind you in the morning session and then the lunch, and after the lunch, that first 30 minutes, the 45 minutes where there's manipulation that goes against the stops of the morning session. If they don't run them in the lunch hour, you anticipate that occurring at noon to 1:30 to 1:45. And that's why you want to be watching and studying price around 1:30 in the afternoon if you're going to be an afternoon trader. But noon to the last hour trading, because it with getting in too soon and guessing where the high and low forms in London. Well, you have that similar advantage, if I can be permitted to use that term here. You have that advantage with the last hour trading because it allows you to have all of the hindsight perfect 2020 behind you in the morning session and then the lunch. And after the lunch, that first 30 minutes to 45 minutes where there's manipulation that goes against the stops of the morning session. If they don't run them in the lunch hour, you anticipate that occurring at noon to 1:30 to 1:45. And that's why you want to be watching and studying price around 1:30 in the afternoon if you're going to be an afternoon trader. But if you don't want to be spending a whole lot of time, you can start your session at like 2:45. Come in front of your charts, take those 15 minutes to go through, see what we've done. What is it reaching for? You have to know where the draw and liquidity is. Where is it drawing to? Where's that overwhelming magnet that's being used to tug at price? It's going to gravitate towards. You're going to find that on your daily chart, your 4-hour, and your 1-hour chart. That's where you're going to be finding the highest probability draws on liquidity. The direction of movement that you're trying to trade within is using a weekly chart. Is it more likely to expand higher or expand lower? You're not trying to predict that closing price on the weekly chart. By having all those things compressed into the small little 1-hour time frame, if you know where it's likely to draw to, you're going to focus on only looking for PD arrays, fair value gaps, institutional order flow entry drills, breakers, order blocks, fair value gaps, balance price ranges, mitigation blocks, everything that I teach on my YouTube channel. Whatever one of those PD arrays that you find easiest to use, it makes the most sense, it resonates with you. But what happens if that PD array doesn't form? Well, here's a news flash for you. You're going to miss the trade. Get ready for it. I miss trades. I've talked this entire thing right here, and I didn't push the button in front of you. I knew it was likely to deliver, but I want you to do what? I want you to see it. Let me be able to communicate over top of while it's doing it. I'll give you 2 reference points for where potential turns would occur if this market was in fact going to keep going lower. I told you to watch the volume imbalance here. Perfect delivery. What does that mean? Delivery. It delivered perfectly to a level where it should stop, which is this closing price. And it does so here on that candle. Perfectly. Not one tick short, not one tick over. And I said, watch this little small range in here. And I facetiously said, there's no way the market's going to care about that little tiny range. No, the market doesn't care about that. But the algorithm does. Because there is an algorithm. Whether you choose to believe me or not, I could sit in front of a courtroom, judge, jury. People can sit in front of me and watch me do this every single day. And I'm going to show you every single day that this is what it's doing. But you're looking at your RSIs. You're looking at your indicators. And that's the distraction. That's why you don't see it. It's literally, that's the misdirection. You can't see the magic because you're watching the misdirection in the hand and never seeing the real work. You're looking over here at this hand when the magic's done over here. Just like a magician. That's what they've done. And they keep everybody engaged in that type of approach. And it's right under your nose. It's been here all this time. It's been here. You can't hide. You can't hide it. It's right there. Go back and look at charts from the 1930s. It's there. But wait a minute, there wasn't an algorithm. Right. There were people that were sitting around literally working together to make sure these markets booked this way. Well, how's that happening? That's another discussion, but I promise I'll give it to you before we close this year out. Mr. Smith. You're going to know him. So the last hour trading, 3 o'clock, we have the run up into what? The volume imbalance. So that starts the show. Do we get respect of that level? And does it hold back price? Yes, it does. It starts to go lower. What are we looking for next? What's the next clue? I'm going to have to, unfortunately, take this out of the presentation because I want to be able to zoom in here and talk about this. I think I've already proven enough here today. And again, if not, then you can go watch Carl's Futures introductory course on YouTube. The swing low here, we do what? We trade through it and come back up into what? A fair value gap? Well, there's one here. But what's below that? Before we get to this fair value gap, after this swing low is taken, right there. But it didn't close below it. I never said it had to. Go back and watch what I teach as a market structure shift. All it needs to do is pierce. But what if it's only by one tick? It pierced it. That's all it is. You're literally going in and you're waiting for this swing low. Why this swing low? Because we've already went into what? That volume imbalance. With the expectation that we're going to trade to 4098.50, which is the last public reference that I gave on Twitter. I think it's 98.50. If it ain't 98.50, it's 98.25. So you'll have to check me on that one. But I know I tweeted it. So we're looking for the markets to gravitate lower. We were expecting the large range day. I told you we would get a big large range day if we got through what? The new week opening gap. Did it deliver? Sure it did. Did I have majority of the position open the entire day? Yes, but I missed this big runoff. That's okay. I've outlined where those signals were here in front of you. Volume imbalance. We trade up into it. We create a swing low here. We rally up, hit it one more time. What's it hitting? What's this candle's high here? 4109.00. Trades back up to this level here on this candle's high. What is the high in here? 4109.00. Oops. Perfect. Perfect. Let that sink in for a second, folks. Do you really believe that there's other books other educators and teachers that was teaching this anywhere before I mentioned it, because I'm going to tell you something, it did not ever happen. Ever. And you'd be surprised that some of those big name authors, they have been talking to me in private for 3.5 years, 4 years now. Yep. You're going to see all kinds of future books from other people, but it was never before this. And it's important to me. What does it matter? Who cares? It matters to me. It matters to me. And if it is a source of contention with us, me being a mentor, me constantly repeating it, it's because I have to. I have to do it. It's like a nervous tick in me. I got to do it. It's the mosquito bite. I got to keep scratching it. And you're going to have to get over it because I'm not going to stop. So when we trade up into that volume imbalance, we want to see it do what? Respect it and repel price away. So when that candle closes and the next one opens, we're looking for no return back to what? Where they removed any mohawk in the lawn. No little seam. So it can go back up and bump that volume imbalance once more. It could easily go up in and trade consequent encroachment too. That's absolutely permissible. But going above this high, not permissible. So it's building barriers. How do you trust the ICT to leave the stop where you put it at? And how do you know that the market's not going to go past? I'm teaching that right now. But you're sitting here worrying about other things. You're not taking notes. You're not listening. You have to write this stuff down. Who knows when I'm going to talk about it again? I have so many other things to talk about this year. And frankly, I'm like a fire hose. I don't know what I've said after I've said it. It's just so many things coming out. And because I'm talking about something that's live in real time, who knows what memories is going to be brought up and what I'm going to use as a framework to say, okay, this is what you want to be focusing on. Not because the logic is going to be different, but because it's in my nature to be a rambler. And I ramble. So let's get rambling. This turning point here is confirmed when this candle fails to make a higher high to that one, or even touch back into that volume imbalance. And then this candle's low is taking out on that one. When we see that, I'm expecting, when I'm watching things like this in price action, when you watch my recordings, I'll say, okay, I expect speed and distance right now. Or I'll type in, it's going to drop hard, or a sharp drop now, as I'm looking for. We would be getting that here. So we now have this low taking out. This is going to act much in the same way that this candle here, being pierced here, it's like a small little shift in market structure. It's an early confirmation that this is most likely going to get tripped. So it prepares you to get ready. So this candle drops below this low. We're looking for this low to be pierced. It does. So now we have a valid shift in market structure with this low being taken there. Yes, you would frame this as a fair value gap, but you don't know when this candle opens and how it closes that creates this, what? Volume imbalance. So in my mind, I'm going to use this volume imbalance on this candle here. If it opens here, as soon as it rallies up into that, between this candle's open and this candle's close, as soon as it trades there, right then and there, while that candle is bullish, it's green, it's a bullish candle, I'm going right in there, selling short. That's how I would use that entry technique. Oh, but you didn't do it, ICT. You're cherry picking. Look at all the examples. I'm selling short in up candles. I'm pyramiding entries when I'm bearish in up closed candles. When the candle's forming, going up, I'm selling into that. How do you know to trust it? I'm explaining it here. You have to know those PD arrays I'm teaching you to look at and observe and study. You don't know which one you're going to trust. I trust all of them. They're mine. You don't trust them yet. So my question, I usually retort when I do take the time, and it's very rare. Somebody will send me a message, send me an email, send me a message through TradingView, or say something to me on Twitter. How do you trust this? And look, what do you look for in my PD arrays? Which one are you using? And it's crickets. They won't answer because they haven't done the work. You have to sit down and look at real-time data and figure out which one you like, and be content with the idea that, okay, every price run isn't going to have your specific PD array. In the beginning, that's actually a good thing because it teaches you to be patient and also to be highly selective about the trade setups that you're looking to participate in. It doesn't allow you to overindulge, which is very, very problematic in this industry because you can overindulge and blow your account. You can have a high success and strike rate and overindulge with leverage and be done in one trade and be blown out. But your strike rate's 90% and you can blow your account on one trade. Being overzealous about building up a large position, pyramid. It happens on YouTube. There's a talker out there doing it just about every other time he gets on the live stream. Next loss day, boom, $15,000, $16,000, if it's even real. You can't control yourself. Pyramiding and build big positions, that's not the answer. You have to know what you're looking for, what PD array you're going to dial in on, and make that your model. Learn that one well. And then when you're comfortable seeing it always forming in the setups that you're looking for, being content with them not always being in every price run, meaning that when there's a move that, well, something like this to here, there isn't any necessity for every one of my PD arrays or the things I use to get into trades with and also measure institutional order flow, keeping the idea that we're moving in the right direction. Not all of them are going to form in that price run. And it's okay. I'm not limited like a new student or a new trader learning this is. But don't look at that as a limitation that is always going to be there. You have to grow. And you only do this correctly by watching price action without pushing a button, observing, saying, oh, this makes a lot of sense to me. Some of you might be looking at this and think, there's no way on God's green earth I would ever look at that as a sell. Okay. It doesn't mean that it doesn't work. It doesn't mean that other students aren't going to be profitable doing it. This means that you haven't warmed up to that specific PD array. Yours would be the fair value gap, and you would not have been filled there. And there's going to be many times, because I see it all the time, there's moves that I miss. I would like to get a part of it, but I don't, because I'm looking for a very specific level. I want the market to come to me. If there's a very specific level I'm looking for, and it doesn't trade there, I miss it. Then I have to go into the move that's already on its way. And as long as I'm not trading outside of that PD array matrix where I defined last night, where you don't want to trade beyond a certain measure, you have to do all your core entry at that point or above if you're short. And in deference to being long, and you're probably, if this is the first video you listen to, what I'm saying here has no understanding. There's no basis to frame what I'm saying, and it sounds like mumbo jumbo, but it's exactly what I taught last night. You have to have a limitation on when are you going to stop taking entries? When does it become less probable? When are you going to stop adding in your pyramid position? You have to have that criteria in your trading. Otherwise, you'll just treat everything as a reason to get in there because it hasn't gone to your target yet. And I learned that lesson the hard way. It turned against me even when I had a really nice winning trade. And I was doing inverted pyramids where I would start with one contract, then two, then four, then 8, then 16, then 32, 64. Well, that means every time I added new entries, the position size was exponentially larger than the previous one. So it would only take a small little retracement to have my open profits be evaporated and more or less eviscerated. And I still wouldn't have much of a retracement in terms of price, but the price movement with a large position, most recently built in, small little retracement back on me, wiped out the entire run of previous open profits on my earlier positions on that one singular trade. So there's a lot of things that you have to weigh out. And you want to know how to pyramid. You want to learn how to run these accounts up. You want to be able to see big, massive equity increases and all that stuff. Okay, I can appreciate your interest and enthusiasm in that. But you have to start at square one. Let's go down here and see how far it went down before it turned around like that. What's that, 78, 75? 78.25 is the low. So there you go. It was a nice run today. Good grief. Hang on 1 second. All right, so when the market pierces this low here, this would be my original entry. What happens if it would have traded up in that fair value gap? I would have added more. But you're adding to a losing position. No, I'm not. I'm building a position within a small little segment of price action below an area where I don't think it's going to go back to, which is what? The volume imbalance. So I'm framing the logic of, yes, I would enter on this volume imbalance as soon as it went into it. But what happens if I didn't have that volume imbalance? I'd be trading into this area here. So I'm putting in my largest position initially here. So if I go in with, say, 6 contracts here, then I'm going to add what? In this area, I would add 3. I'm cutting the original position size and leverage in half. And then as the market breaks down, we see it trade below these lows. We have a lot of energy here, and it comes back up, closes here. I want to see this immediately overlap that wick. Why? Why would I want to see that? What have I been teaching you about consequent encroachment in wicks? Midpoint of that gap can act as what? Support and resistance. Why? We see it trade below these lows. We have a lot of energy here, and it comes back up, closes here. I want to see this immediately overlap that wick. Why? Why would I want to see that? What have I been teaching you about consequent encroachment in wicks? Midpoint of that gap can act as what? Support and resistance. So we do not want to see this candle open, come back down, flirt with this midpoint here, and then start to rally back up. That's not what you want, because what that's occurring, where it's occurring, doing it is below old lows. And what that means is it could very well retrace back up, in the human error of not thinking that you're going to have that fair value gap trade to. It could do there, could do it right there. And then had it done that, then I would consider, well, I could put on 1 contract, and then hopefully not see this volume bounce retraded to and get stopped out. But that's the risk that you open yourself up to. How do you know? You don't really know. It's just you've been doing it for so long. You use the logic that repeats over and over again. Most times, not all the time, most times.
What's your favorite PD array? I honestly don't know. Order blocks and fair value gaps. I take notes. I got a notepad I use, and then after that, I go and type them on Notion sometimes. That's how I take notes. I don't, because I like to write it by hand.
Well,
first,
I could put on 1 contract, and then doing it is below this and act as what? Support and resistance. It could very well could do it right that you open yourself up to. How do you know? You don't really know. It's just you've been.
Yeah, see, consequent
doing it for so long,
you
use the logic
of a wick or gap.
Repeats over and over again, most times, not all. Hopefully not see this volume bounce retraded to and get stopped out. But that's the risk that you open yourself up to. How do you know? You don't really know. It's just you've been doing it for so long, you use.
You've just been doing it. I think that right there, this right here is like such a good gem.
It's the logic that repeats over and over. again, most times, not all the time, most times, and then you trust that experience. So in this case here, this candle opens, delivers, and re-delivers this entire range of that wick. And we close lower and have a lower low than that one. So everything's good. Then we open down here, we have a volume imbalance. We trade lower, then we retrace back up. Midpoint of that gap, consequent encouragement. Now think, what do you see here? I swear, I wish I had this when I was coming up. I could literally sit here and watch this. Like, if someone was talking like this, I could watch them all day long. Like, I love this. Like, I love price action. I love analysis. I love being in it. This wick here, we measure that here. So that's consequent encouragement at 4100.75. What's the open on this candle here? I'm sorry, I said open. What's the close on that candle? 4100.75. That's consequent encouragement. And the open on this candle is the same thing, 4100.75. Okay, big deal, right? But it goes up a little bit. Why is it doing that? Remember, it's to make it seamless. It's not going to go and bump up right to the old lows exactly all the time. Because if it was like that, number one, I believe it would have been more easily observed by other people. They hide it by having this little bit of an overlap. Because if it always stopped in the middle of the wick like this, people would have it in books. Years ago, it would have been in books. It's not. It's not in books. Here's your algorithm, kicking it at 10 minutes to 4. There's buy side right here. So you have a volume imbalance here. I would use that here and allow for price to trade up into consequent encouragement of this wick. So this would be a point of adding more. And then if it could get to consequent encouragement, I would add more there too. But you're adding to a losing position. No, I'm not, because I will be net short from up here in this volume imbalance, and I have all this position here with the largest portion on initially in that volume imbalance there. So 6 contracts short here, it trades down, comes back up, volume imbalance, 3 contracts, 1 contract, consequent encouragement. Where would I not want to see price trade to now? The middle of this up close candle, because that's your bearish order block, up close candle prior to this move lower. So there's displacement after that. We've taken out that low. There's no need to come back to this level if it's going to go to those 4098.50 level I mentioned on Twitter. So it's you're reading the tape, you're reading order flow, you're weighing out whether or not that the market continuously keeps balancing and repricing, balancing, repricing. So it's permissible for it to trade up to this level here. It does so. So now what has happened right there? From here to here, I gotta change the color of this. We had this range back and forth between this candle's high to this candle's low. We trade all the way back up to this candle high, and then we leave the range here. There's no necessity to enter back into this range if that target 4098.50 is in fact, here's your buy side, I told you I was going to reach for, the target of 4098.50. So because this is a balanced price range, why doesn't it have the necessity for price to come back up into that pink area? Why shouldn't it go up there? Because price has done what? It's delivered pink, down, then up, then down. Buying and selling pressure had nothing to do with it not going back up into that level.
So that's why he talks about the return to the original consolidation in a market maker sell model. I'm pretty sure because it's a balanced price range.
It didn't even come back to touch the bottom of the range, which is this old low here, which is what? Classic support and resistance, right? Classic support and resistance. Support broken, turns resistance. Well, you missed the party. See you later. Consequent encroachment of the wick. That's where algorithmic smart money composite men engage right there. And we don't need it to come back up here because this candle went down to this low. And the next candle it happens to be opening up here and delivers once more over top that range. So what's occurring here? This balance range, balance price range, yes, it's balanced, but now we have a smaller balance price range here. It doesn't need to come back up into this area. It trades lower and then trades over top of it here again. We leave that range and come back up. What can it do? What's permissible? Halfway. Halfway, which is also consequent encroachment of that wick. There's a convergence of factors coming there. When I'm looking at price, my eye's looking at all these things, and I'm reading everything from each one of these candles. Now imagine what I've already said here. How much time would it take me to annotate that in the chart, typing it out? I can't. Not when I'm on the chart and I'm trying to read it and decipher all that stuff. I can't do it. So when you're watching price, you're looking at it and you're deciphering, does the feedback that you're getting from price supporting the idea that it wants to keep going lower? The fact that we don't go back up in this area is great. The fact that the bodies are respecting the consequent encroachment of that wick and the mean threshold, because we're measuring bodies of candles here, both consequent encroachment and mean threshold converge at the same area, which is this level right there. Look. 4100.75. That's the close and open of that candle. The small little variance in price, you have to allow for that. Don't let that scare you. Don't let it be a source of fear or anxiety. That's normal. That's a normal thing in price delivery. Get this off here. So now price goes up into that area. We want to see, and I would be saying if we were doing a live trade, I'd say we want to see it deliver and go lower now. It goes down. So what's it doing here? It takes out this low here. So now this low to this high here becomes what? A balanced price range. Because the market has delivered both directions of buy side and sell side. Between this here, our old range, down to this low here, the market trades back up to what? Consequent encroachment. So consequent encroachment becomes the high end of the new balanced price range. Because we've traced back that far, there's no need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint this? You have to allow for that. Don't let that scare you. Don't let it be a source of fear or anxiety. That's normal. That's a normal thing in price delivery. Get this off here. So now price goes up into that area. We want to see, and I would be saying if we were doing a live trade, I'd say we want to see it deliver and go lower now. It goes down. So what's it doing here? It takes out this low here. So now this low to this high here becomes what? A balanced price range. Because the market has delivered both directions of buy side and sell side. Between this here, our old range, down to this low here, the market trades back up to what? Consequent encroachment. So consequent encroachment becomes the high end of the new balanced price range. Because we've traced back that far, there's no need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint the same section of the wall 5 times? No, you're wasting paint. Price isn't going to waste time. Time is important to it. It only has so many trading hours in a day. So you take your eye and your attention. You don't want to do this when price is trading live because you'll miss what you're supposed to be focused on. But you want to be referring to it while watching price. So again, we're thinking paint. No need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint the same section of the wall 5 times? No, you're wasting paint. Price isn't going to waste time. Time is important to it. It only has so many trading hours in a day. So you take your eye and your attention. You don't want to do this when price is trading live because you'll miss what you're supposed to be focused on. But you want to be referring to it while watching price. So again, we're thinking I'm sorry, I thought my son was calling me. We're thinking that the price is going to continuously go lower. The market trades back up into this consequent encroachment here, which is now the new high of the balanced price range. There's no necessity for it to trade higher. Does the willingness of price reflect wanting to go lower? Yes, it does. It takes out this low here, and then we come back up. What's permissible? If this is a balanced price range, it's painted price down, offered sell side, then it offered buy side to the area where we're expecting to see price go to anyway. Then it should go lower. It does. It leaves that price range. Can it go back up into this range? Yes. How far? Halfway. Because we're measuring bodies, we're looking at it through the lens of what? Mean threshold. Man, I should have charged you money for this. So here is the mean threshold, 4097.50. That's what you could reasonably be traded to, and it's permissible. It means it's allowed. You can expect that, and it doesn't upset anything. The market fails to go there. And what does it do? It trades lower than that low now. So we're expanding our range, and it breaks lower. We don't even need to go back up to mean threshold. We're looking for now any further advancement lower. What does this area here now become? Between mean threshold, which was never hit, this to this is your new balanced price range. Does market want to trade away from that? It does. But now we're late in the day. What time of day? 15:24. So it's 24 minutes after 3, New York local time. It's going to run. It's going to aggressively reach to the liquidity it's going to aim for the day. It aggressively runs. Trades to whatever 40.78 becomes. I don't even know what that is off the top of my head. In my notes, I don't have anything that jogs my memory to that. It hits it at what time? 15:34. So 34 minutes after 3. And then 20 minutes to 4. You want to be sitting and waiting for price to run on liquidity because at 15 minutes of, if you haven't already seen it by then, it's going to really aggressively run on liquidity that has not seen or hasn't been tapped into. Meaning what? I told you the buy side liquidity would be right here. Where does it go? Right there. And now we're at a time of day where it's just going to trade listlessly now between this high and that low. And simply because the market's moving around and fluctuating and it ain't 5 o'clock yet, retail traders are going to try to trade in that and get caught up in a mess. When the only thing it's done is it's created a low, we come off the low, and it does a simple macro. It repeats over and over and over and over again. But reading price and understanding the order flow is essentially what I'm showing you here. Every time we have an overlap of price. If sell side's offered, it means it's going down, a down candle. If you're bearish, you want to see that down close candle be redelivered with an up close price movement. And then back down. It does not need to close. It doesn't need to close with an up candle if it was a recent down close candle. So what do I mean by that? What will be an example of that? All right, say how we have this down close candle here. Say the next candle opened up and we traded up and overlapped all of that and then went down and made a lower low. And so it would have a wick there. That's the same thing as what I'm saying. It has to have both, every range between one price level and another to be determined and deemed efficiently delivered is between both price points, between any price point range in a price run. It has to offer both directions. It went down and up. Down, then up. Or if it starts with up first, it's up, then down. And it has to overlap the entire range of whatever has been delivered. So that's what I've walked you through here. Unless someone does what I just did, you don't know what I'm talking about. And these other folks out here trying to pretend they know what I'm teaching, they have no idea what they're talking about because they're never doing that in their videos. They're never explaining what it is that makes the market efficient or inefficient. If the market trades back and forth between price points that are defined as I'm teaching you, if they deliver both directions, that's efficiently delivered price. When it doesn't do that, it creates these things like this, where you have a separation from one candle's low, one candle down, the next candle is a lower high than the previous candle's low on these 3 candles here. So a fair value gap is 3 candles. The identification of the inefficiency is always the candle in the middle, and you define it by the candle prior and the candle after. And that segment of price action in between becomes your fair value gap. Okay, so that's your fair value gap. It does not mean, just because we go up here like we did here, is that a short? No. Why not ICT? Because it's a fair value gap. You should be selling short there. I should be able to do a pyramid entry there. Well, no, you shouldn't. And why would you want to add or enter a position that's been going down all day long at 11 minutes to 4? You don't want to do that. You never want to fade afternoon market reversals like this that close to 4 o'clock, because many times it'll ramp up against you because what? It's going to want to induce short covering. Why? Why would they want to do that? Because they want to have order flow coming in so they can, the composite man, can use that order flow to balance books. There's commerce coming in. It's not just all speculation. There's transactions that are coming in all the time. I'm talking about currencies here. I'm sorry. Like if you're looking at trading the currency market, they're going to use specific times of the day, like London close, between 10 o'clock in the morning New York local time to noon New York local time. They'll use that little window of time to facilitate order flow coming in that London close condition, allows all of that new volume coming into the marketplace, short covering or selling longs. That order flow, they use that for the commerce aspect of Forex. So again, it's not all just speculation and traders like us sitting around trying to make money on different fluctuations in price. Sometimes it's just real business needs when it's relating to currencies. And I think that is going to be it, folks. I gave you an example here live. This is my second live stream. I gave you 2 points of reference, the volume of balance here and the volume of balance here. And I think that will suffice for this week. It would be an encouragement to me if you would give me some feedback on Twitter. You're welcome to say whatever you want to say, but when you say something that's derogatory or disrespectful, I'm not going to block you, but I will mute you. So I won't ever see anything you're saying. Other people can see what you're saying, but I don't care to see it. But if I was a source of education and insight and encouragement this week, I would greatly appreciate that. I'll be looking through those tweets this weekend coming up. I'm not signing off, obviously. We have tomorrow's trading, and I'll probably be tickling your Twitter tomorrow.
All right, finish that bad boy. I've already journaled this day. But yeah, 1050 macro, we get a nice retracement. This got to be constant encroachment of one of these wicks. Oh, really? Oh, this is his Twitter archive. It shows all the Twitter. It's in my Discord. Oh, this is beautiful, beautiful. You have buy side taking SMT shit to market structure. You have a fair value gap right there, offering low resistance liquidity here. They pull back into that. Have another SMT here within this imbalance, and then we break lower, come right into this imbalance right here. We leave this as a breakaway. Let me just pull it up. Do I saw my anal? Oh, it's the 9th this day. Whew, just beautiful. It's got what time 15-minute PD raise do we have that in, Mark? Okay, we have a 15-minute order block right there. What's consequent encroachment? Almost respects that perfectly. What about this wick? This is nice. This is such a nice day. His most recent live, I don't think it is that. I'll look at it. It's definitely not his most recent live. He did like a 3-day workshop. I remember that. Why am I looking at my channel? It's not this one. Is it this one? No, I don't think it is that one.
Right. And would I capitalize on that? Price run that is being led by, I can see it from my charts, but I want to be able to for that MQ to get onto it. don't care about the calls being mentioned. Not, it's not that I frequency trading showing in that little, out of from where it was together and off, and you'll see it do this.
That wasn't it.
Left-hand corner. Really like me. I promise what I'm going to show you today, it's going to help you if you allow it to. Okay? So, all right, folks. That takes us to a little over $1,100.
He sounds depressed.
So think about what's being, or inversion fair value gap. Buy side here, here. You're self-trading. You're want to be done by 11 o'clock. You're going to have to pay that toll. Everybody pays. So that's a winning trading with a funded accountant. It's not real money. But eventually those losses will take you to, and I don't remember.
That's got to be the stream. Oh, look, you just closed it. I don't know. People get worked up over that. I really don't care. You know what I was thinking about? I kind of want to delete my Discord server. I'm going to be straight up. I was thinking about that earlier. I kind of want to delete the Discord. I don't know, because I feel like having a Discord gives me like guru vibes, and I ain't trying to do that. Plus, like, I don't really use it too much, and I think there are other valuable Discords, but Also, I don't want to make people mad and delete a Discord that they mess with. What's going on? Just chilling, taking notes. I don't think it gives guru vibes. Okay. That's all. That's all the notes that I'm going to take for that. And I always hate deleting my annotations, bro. It's like depressing, honestly. It really is. Next day is opening up here. We just came off an hourly PD ray as well. Alright, so we're in a deep discount here. Notice how price heads to true day to give smart money a chance to accumulate more shorts. Is there a daily level there? Doubt it. Hold this in balance. It's got to be a 5 minute. We reprice back to that 5 minute inefficiency. What about this? Oh, almost constant encroachment of that. Let's look at what ES does. ES is a little bit different. We actually have S&T at the lows. Well, we come right up into a new day opening gap, take buy side. That's the 2022 model right here on the 5 minute. And we see sell side. So NQ actually comes down and takes 7 a.m. low. So we have S&T here. We have S&T at the highs. Yeah, and we have S&T at the highs at 340. So we come up originally, put S&T at the highs. We come back, we deliver, put S&T in at the lows. 9:30 opens up. Usually get a little Judas swing higher into a 1 minute imbalance right here into true day. And there's not really much here. We get a sell side liquidity raid here. Market structure shift imbalance. That'll be a 2022 model. And you might have took a loss here. Come back lower, take sell side once more. Then we head up to buy side. Remember, what's overall bearish? What's overall order flow on the higher time frame? Right now, currently, we've had change of state delivery. We're within this imbalance here. So I would say bearish. Oh, wait. I would use the high because it overlaps with an imbalance. Oh, look at that delivery. Right to that order block. Beautiful. So we actually come up, we take buy side here, and we form SMT. So what does that mean? SMT, we taken buy side on ES but not in Q. So I would treat that as a buy side sweep there. Market structure shift, imbalance. That is a 2022. And then we get displacement. Take sell side. Five minute. Right at equilibrium of this price leg. What time is this? It's 11:10, so it'd be an acceptable time to take a short too. So did he nail that low? When did he tweet that? That happened at 7:55. No shot. Oh, we put a very nice swing low in here. Oh, wait. No, it is the 10th, I think. Yeah, it should be. January 31st. 60-minute for value gap. At 8 a.m. So this one. Dang, bro, thought we were selling off that much. Oh. Is it happening at like a 15-minute imbalance too? Sorry, I haven't taken that off. Oh, after we've taken this buy side liquidity. Wait, no. It's happening within this. And then we come up and we take this buy side. A new day. That's this very small new day opening gap. It's respected. Above true day. Fantastic. Within a macro. Whew. Pretty much that macro makes that high. $15 handles too. Oh, we get another fair value up here. This is some nice PA right here. You have a breaker right there. It's probably like a 2-minute order block. Right here. You have a nice 2-minute order block within that fair value gap right there on the 1 minute. Displacement 1003 and put in a low, and then we reprice higher to take buy side liquidity. You just gotta type it in the contract code. If you type in the contract code, you can go back into time. I just have like the $15 version or whatever. $40.98. It's talking about these equal highs. Now you have a breaker. What fair value at? 410. right, then it's a tape read on the final hour. Notice how that CE is the 830 opening price. We respect it. We get a change of state delivery here. Swing low formed, change state delivery. And then we actually head back up to these equal highs again with SMT at the lows. Last two down close candles is the order block with the opening price of that. This could have been a loss here. To engineer, not induce. 2 minute looks clean here. -2, -2.5. Unchower run on stops. Oh, this is gorgeous, bro. Immediate rebalance. Immediate rebalance after consolidation within this down close candle. Then we reprice back to equilibrium, and then we have another buy model here.
I'm sitting here trying to talk to him. Oh, feedback. Momentum. I apologize. Like I said, I haven't been feeling well, so I'm going to probably clear my throat too much and get on your nerves, but it's either that or I do it silently. All right, so I'm looking at the last hour trading here. It's Friday. Part of me wants to see that high stay intact simply because I gave you the low of the day and so far the high of the day. And the two contracts I had remaining, I peeled one off at 40.98 and a half, and I told you I was going to leave the other one on for 41.01.50, but the spread between the bid and ask never got offered to the point where I would allow my order to fill. And my stop, I told you on Twitter, would be 40.84.5, and either one would be, stopped out, whatever. And there's where my fill was on that last one being stopped out. Excuse me. This one here, I was doing some scalping, running back up into this fair value gap. I believe you should have that on this recording if I've done everything correct. But I was talking, I was talking my way through it, and I realized that I hadn't checked on the audio. So I'm learning as I go, folks. I'm sure it'll be better as we get through the year. All right, so does this want to do, there's a volume imbalance down here. It's Friday, short covering, 10 minutes after 3. There's two things down here I like. I like the volume imbalance and the fair value gap in here. I'm gonna in hindsight, I wish I wouldn't have taken my best friend out for dinner. Not to seem mean or anything, but this is annoying. He had a cold and gave it to me, that's why I'm complaining. All right, so we have, in my opinion, these highs up here. It's still too early to call it for the last hour because it could easily just pump up in there and run out to 102.50, 102.75. And I don't have anything in this as a long that I would favor.
Look at this swing low. Short term, intermediate term, short term.
All right, so now we're pulling back into this range here. Let me get this order block here, and then we have a higher down close candle here. This is a propulsion block. So any retracement here should be kept at bay. It should not go below the midpoint of that candle. That's the rules for a propulsion block. Meaning that if this is going to rally, it should not go through halfway, and we'll just eyeball it and use that high here because it's approximately it. So let's watch this and study it.
Almost trades into this imbalance right here.
Okay, we have a smaller fair value gap here now. See how it came down and touched the top of this candle, the open? But my eye is here, and that right there. We don't want to see that. We don't want to see it go through it. It can touch it, but we don't want to see it go through that. Propulsion block, and these are the rules are in the core content. If it trades through it, then it's, in my opinion, probable cause for it to want to go down into this area here in this volume imbalance. You may hear my son's carrying on. I apologize. I'm a dad. Here, since we went below that propulsion block mean threshold, which is a barrier that we don't want to see occur. Trades up into it here, and then reprices lower into the fair value gap and the volume imbalance. So we have a small little area here as well, and this low here is sell side. So you can annotate that. And actually go through this. Volume imbalance I'm a little bit more flexible with because there's such a small range, and as I was teaching last night, the market likes to see a seamless delivery, meaning that if it's the level, it might overshoot a little bit. So how far can it overshoot to this candle's low? That's permissible. There's sell side below this low, and the buy side imbalance, sell side inefficiency that's between this candle's high, that candle's low. I will want to see if it tries to get down below this low and fill in all of this and reprice to that low. Now, assuming that it gets overzealous and goes through this area, we're repricing back to the volume imbalance here. We have relatively equal lows here. Sell side would be below that. Now, when you have like this low here and this low here, they're essentially the same. So you have this low at 85.25, and this low here comes in at 85.25. And if there's a small little wick over here just beyond it, I'm not going to outline it with this being the level. I would just simply look for that. Okay, as I mentioned a little bit ago, if it were to go back up and overshoot it, this is permissible. This coming all the way back up to midpoint of this, that's reasonable. It's rare that it comes all the way back up, as I was mentioning last night with the balanced price range. So it would need to immediately reject this and go lower if it's going to go lower. Get this out of the way, sorry. So these are all the things that I'm looking at price, and does it do these things? These are signatures in price action that I'm looking for to either confirm or negate an idea that I'm watching or studying, maybe for an entry or managing an open position. Or in this case, tape reading with all of you, which is just simply observing price action and fading, making reference to certain things that would otherwise be unnoticed by you. That's what we're going to see down into that fair value gap here. Now watch consequent encroachment, which is the midpoint of the gap. It's at 87.50. Yeah. It's 87.50 and 86.75 respectively. So far it's only hit the top of the fair value gap. The cards. Shuffling the cards. Okay. We're just moving in between a dealing range between this low and this high. We made an attempt to run up and challenge this old high.
Here you have breakaway, measuring gap, terminus gap.
And this fair value gap and buy side liquidity pool resting above the short-term high was enough, and the bodies respecting the consequent encroachment of that midpoint, and we bumped it one more time in here. So all I'm doing is small little micro market structure observations with you. Now, watch this one in here because that might be where we're gravitating to. And be mindful of the volume imbalance. One of the things that you're going to have is a source of confusion, frustration, is knowing which PD arrays to be more flexible with. Come on. There we are. And one of those are my volume imbalance. So I allow price to to move through it back and forth, and then come back and use it again as a support or resistance level. The fair value gaps, I'm not that loose with. Like, I'm demanding them to do specific things. Now, if they're broken and price goes away from them and comes back and goes back above them or below them, then it can be reclaimed. But back and forth type price movement like we're seeing here, that's, for me, and what I've grown to trust with my volume imbalance, which is, again, a separation between two candles' bodies, but the wicks can touch or overlap, that's fine. The identification of that in price action. Let me put this in here too, because I saw a couple people mention it. They're saying that their broker feed or their broker doesn't show, or sometimes if they're looking at the micro account or micro contract, first, like this is a mini, then the micro MES, sometimes it doesn't show the volume imbalances on there. I'm not aware of that because I don't really watch the MES, but the way you would combat that is simply just watch the price action of mini and trade with that insight using what you see on your EMS chart. But I'm comfortable allowing price to, here's the mean threshold, I'm sorry, the consequent encroachment of the fair value gap here. So now our attention goes to right below here, and this specifically, so we have this buy side imbalance, sell side inefficiency, the lower end of it here, sell side, and we have an order block here. So let's see if we get the price to want to dig down deeper a little bit. Volume imbalance, volume imbalance. So it can reprice back up into this area here, but it would be better if it didn't, because pushing back up into that, if it launches through it, then we're going into this area here. So you probably think, what's the benefit of this? Well, what's the benefit of watching price action today? It was rather lethargic, choppy in certain times when we were covering it in Twitter. And then ultimately, I gave a 10-minute filter. I was like, I'm going to give it 10 minutes and see what it does. And then it gave me something to work with. And I outlined it, walked you through it. And I'm sure some of you did what you weren't supposed to do and trade it. And I called the high at 41.0150, which at this moment still is in place as the daily high. And this morning, really early before the New York session, I mentioned the low, right to the tick. So both high and low have been shared with you. Goober on Twitter was telling me, but why'd you say it could go? Because anytime a Fed speaker, anybody from the Fed is talking, it can create wild price action. And when you're new to trading, you don't understand that. So you have to make available allowances for you being inaccurate or traditional expectations or rules go out the window when Fed gets involved. So the Fed effect is, all the rules go out the window, and you got to prepare for that. So the low I called this morning, and the high that I have here, when a Fed speaker or Fed representative is jawboning and talking, their words are going to be utilized as a smokescreen for price to do what it's going to do. But you're told it's the market reacting to what they're saying. And I'm sorry, I'm not a subscriber to that view. Doing something with cards in hand while I'm watching price, because it's just I gotta keep my hands busy doing something. I just can't be standing in front of my screens. So I practice shuffles and such, but let's see if we can stay under this volume imbalance. Look how spotty price is right now. And meaning, what do I mean by spotty? You have volume imbalances in here, 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 and the one over here. So it makes it difficult to get a real smooth, like obvious run to this price level, react and go lower, or run to this price level, react and go higher. So it can go back and forth because it's referring to all of these specific PD arrays, which makes reading price and taking a trade much more difficult to trust. And where would you place your stop loss? Because it can bang around in here and then ultimately run on one of them as its baseline premise, with supporting it as the PD array or the multiplier for price to start moving away from. It's hard to get a read on that when there's multiple ones like that. So when I say market's spotty, that's what I mean by it as multiple volume imbalances. It's very porous, put it that way. And when there's porous pockets in price, it's going to want to spend more time in there rebalancing that. And the way you rebalance is you reprice to it, you leave it, go back into it, and fail, and go the other direction. And since there's multiple ones, it means as multiple volume imbalances. It's very porous, put it that way. And when there's porous pockets in price, it's going to want to spend more time in there rebalancing that. the way you rebalance is you reprice to it, you leave it, go back into it and fail and go the other direction. And since there's multiple ones, it means you're going to see it go back and forth, back and forth. So we're up inside that fair value gap. Lots of equal highs here. Now, if we were to rally and come back down and find some support here, then I think because of time being 3:30 now, we might see a macro run us up into these highs here and take out the buy side that's resting over here. So one of two things are going to happen if that's exactly what's going to unfold. And I'm not 100% certain it's going to do that, but I'll stick with that narrative here. If it goes above it, finds the support here, then it would look to rally. Otherwise, it's going to rip right on through and not even look back at it. Okay, so now, because we have this gap here, the one that's shaded, and we have a swing high, we now have technically, quote unquote, a market structure shift. After trading into a discount fair value gap, after taking sell side here with this drop down, we're bumping up against this fair value gap, and we would want to see price stay wanting to go higher. This fair value gap, you have to be mindful of that, so you just can't take a long here and put your stop loss there because you have this inefficiency, and it can come back down into that. So your stop would have to be down here around 89.25. So we've had a really perfect delivery to the low end of the fair value gap here, and we'll see if it wants to rally up and start spooling higher. This is our bearish order block. We don't want to see this act as a speed bump, meaning it wouldn't be ideal for it to hit this and be slowed down at all. We would want to see it go through that, and more specifically, not just enter it, but go right through the midpoint of the candle, which is mean threshold. So when I'm watching this area like this, and I'm thinking if it's going to reach for buy side or attack the daily high going into the close on a Friday, if I have an order block like this, I'm watching price and I want to see it needs to quickly go into the candle's body and go right through the midpoint, which is mean threshold. That's the qualification. That's a little nudge that I'm on side. I'm confident that it's going to do what I'm expecting it to do if it runs quickly through the midpoint of the order block. If it does a run up here and just bounces away from it and just meanders around, that's not as ideal. It means that it could consolidate or it could reverse entirely and come back against the idea. So I'll annotate the mean threshold on this candle in the event if we get a run. So what is that? 95.25. So we would want to see it rip into 95.25 aggressively and run right through it. If it's going to rally and go for the buy side, that's how you know to trust it. How do you know, ICT, to trust these moves, yada, yada, yada. And it's because of that. It's tearing into the order block and not respecting the mean threshold, which is this little red level here. You folks are getting spoiled this week, all these sessions of the good old ICT. All right, to see what it's doing here, this is what I don't want to see. This is what I've just explained to you. We don't want to see it go into the order block and fail to run up into mean threshold and tear through it. What is it doing? It's retracing back down into the fair value gap. That is something that you don't want to see, and it takes much more for it to turn around and go higher from this point. And if you're in a trade and your stop's at 89, as we indicated down here because we have this fair value gap, it can be a little unnerving for you when it digs that back down into that fair value gap. So we want to see this candle here or the very next one, because it's 52 seconds before the turn of the new candle. We want to see the next candle when it opens immediately run higher. Not even mess around, just rip higher. Does it tear through mean threshold? We don't want to see it respected at all. Dude, that's not what we want to see. We don't want to see that. So what you're watching is you don't want to see that candle turn on you. It's got to stay above its low. See it through. Okay, so now we're okay. Now watch the buy side over here. And much like we just described on the order block here, we want to see the same event here for this fair value gap. So while I don't have this on my charts, my eye's going to these points over here, and I'm saying, okay, I know that price is roughly here at 40.97.5. I want to see it rip through 47.97 rather, 40.97 this price here, essentially midpoint, or consequent encroachment of the gap that is between This candle's low and this candle's high with this one little unclosed candle. All right, so we would want to see large range expansion. Usually when you see me doing my recorded trades, I'll type out and say, I want to see speed and distance, or sharp decline if I'm looking for it to be bearish. I want to see big range up, green, big up candles, that's what I'm saying. I want to see large range green up close candles. You see how fast we went right to the consequent encouragement at that mid-level right here. When I see that, I feel like that's like a confirmation that you would be on side and I'm on side if I'm expecting it. So I would reasonably expect to see it go through here. Now, if it goes through here, we want to see it expand up with a lot of velocity and speed so that we can dig into this level over here and take out that high, which in my heart, I wish I would just not see it taken out because 4101.50, even though my last contract didn't get a fill because the spread, the high and the low was called to you in advance today. Fairy tale stuff that they say can't be done. So you can see it's already moved about 5 handles or so. What's the open on that? I'll close rather. 9250, and there's your 5 handles, and it's tearing through the fair value gap, coming back, touching it. Watch the low. It can come back and touch that. It's fine. If it comes outside the fair value gap, watch the consequent encouragement of this wick. That's what my eye's going to. When I'm looking at it, I'm watching, does it support it? I need 3 PD arrays. 3 PD arrays. Once I see 3 of them break, then I'm going to collapse the trade or take some of the trade off. In this case, nothing here is problematic. It should have an expansion here on this candle.
I would agree, bro.
Rip through that buy side liquidity and then dig into that 4100.
I don't know. I don't think I'll ever like try to trade, or at least for now, try to trade PM session, but
it's fun.
PM
and this has always been available to you. You just haven't been doing it.
This day is clean.
And when you do this, you learn what it is that I'm doing.
I've
been doing this for 30 years, so obviously I'm going to be better at it. But in the beginning, you got to get past that uncomfortable not knowing what you're doing, and you observe things and record things, and does these things repeat over and over and over again. So we have buy side taken here, and that would have been a partial for you. So buying the fair value gap, as I mentioned here, we're going to use the top of the fair value gap, which would be the equivalent of this candle's close. I don't want to say that you would have got filled down here because that's not practical. But the closing price here is essentially the same thing as the high of that fair value gap. So 4092.50. So 7 handles from here to here, running out buy side. That's not a bad move. It's a bread and butter type setup. It's real easy. Those things happen multiple times in a day. And you could roll your stop to +1 and just see if you have a run up into new highs on the day. But you don't want to be limiting how much you're going to get, because when it gets close to this 345, 350 time window, the macro in the last hour can start really sending this thing higher and run out through here and then keep going a little bit more. So you don't want to ever shortchange yourself in that opportunity. So you could have a limit order to take something off at the new high, like 101.0175 or 4102 even, and then have a runner to see if you can get any kind of additional expansion should it materialize. We don't know because this is a buy side liquidity pool that has been purged already. Here, volume and balance. Watch that right in here. The consequent encouragement with the wick here. So about midpoint. Draw that out in time, and you're watching, does price touch it? And if it does touch it, does it disrespect it and go right on through it, or does it fail to even go to it and resume going higher? That's what I'm considering when I'm watching price. I'm not looking at indicators. I'm not looking at moving average crossovers. I'm not looking at supply and demand zones. I'm reading very specific algorithmic price levels that are going to key up on what you would expect in support and resistance. These things do offer that. If you're watching this video live and you watch me outline this 7 handle run here, do me a favor and give me a thumbs up. I was watching, because I'm doing this for free, and one of the things that I would like to see you do is support the live streams. You're not paying for them, but your payment to me for appreciation would be the thumbs up. The more you inspire me to do that, the more likely I'll do more of these. Obviously you can see it's no real effort on my part. I just didn't want to do them before because it's a pet peeve of mine. Every single time we meet, Price seems to know how far I can go on its leash before we close our session out. And that, my friends, is fun. That's what we're looking for. Notice how price went down into this wick here. Consequent encroachment. Beautiful. Redelivery. Buy side. So you notice probably when I'm looking at a run, every time it makes a new high, I always annotate it like this, and I'll take a partial when it hits there. You will be doing that too. So this is called running down equity. So right in here. Now, because we've had one high taken here, and then this high took out that high, we don't want to see any kind of reversal. So this low here needs to stay in place. We don't want to see any of that coming back on that, because then it's problematic, and we don't want to see it basically. And now we want to see an energetic big run up into like 4104, 4105. Big candles pushing really hard, because there's a lot of orders that are resting up here that are layered. That means they're like all up in here. The books will tell you to put it right above the high, but some other traders and fund traders will think, okay, well, let me just go a little bit deeper than that, and I'll be really protected. And that's why when you see in later parts of the day, the old intraday highs and lows, they'll get really ran out because they're seeking the liquidity of the funds. And funds have their stops, not just one tick or 1 point above it. It's several handles above it, as much as 10. I know, it's fun. Oh, ICT, why didn't you do this sooner? Because all this is your responsibility. This is the work you're supposed to be putting in. But I would have been able to quit my job back in 2016. You still can, but you're going to have to do it on your own effort, not following what I'm talking about. Anybody can follow what I'm saying. That's not skill. I'm just showing you what it looks like, showing you the principles and what you would be doing. And funds have theirs up here that are like 4104, 4105. Big candles pushing really hard, because there's a lot of orders that are resting up here that are layered. That means they're like all up in here. The books will tell you to put it right above the high, but some other traders and fund traders will think, okay, well, let me just go a little bit deeper than that, and I'll be really protected. And that's why when you see in the later parts of the day, the old intraday highs and lows, they'll get really ran out because they're seeking the liquidity of the funds. And funds have their stops, not just one tick or 1 point above it. It's several handles above it, as much as 10. I know, it's fun. Oh, ICT, why didn't you do this sooner? Because all this is your responsibility. This is the work you're supposed to be putting in. But I would have been able to quit my job back in 2016. You still can, but you're going to have to do it on your own effort, not following what I'm talking about. Anybody can follow what I'm saying. That's not skill. I'm just showing you what it looks like, showing you the principles and what you would be doing when we're not doing it like this. Now we want to see it rip higher here and respect the down close candle here, which is a bullish order block. Now I want to see a big run up, real sudden, boom, boom, like two big bullish candles rip into that 4104 level, 4105. What do we have there? Another wick. See that? Does it support that idea of holding it at bay, or does it dig through it and completely go back down into the range of this wick? Because the consequent encroachment of that wick is here. So it can come back to here, but we don't want to see it completely wash out that candle. Or does it dig through it and completely go back down into the range of this wick? Because the consequent encroachment of that wick is here. So it can come back to here, but we don't want to see it completely wash out that candle. I'd be lying if I said I didn't want to see it crash here. I don't want to see my 4101.50 high breached. But it's probably going to happen, so that's okay. It's not the first time I did the daily high and low. And it's probably not going to be the last time. It's real hard to argue about the markets being algorithmic now, isn't it? Controlled, if you will. After seeing a week like this. How on earth does he do this? Where does he get these toys? From another dimension. Alright, so here's our last chance to see it rip through. Big caffeine bar. Big, huge caffeine bar. Just push, 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 real big. A little bit more than that. So you've seen the 4101.5 levels breached. So anybody that would have been having a stop loss beyond where mine was, and they were holding on to it, there's your fill on that. I'm just not comfortable with having all that retracement all that time. There's so many other trades, as you can see here, I've been outlining here live with you. Remember, we're looking for 4104, 4105, layered, fund, open float. About 30 more seconds. Last 10 minutes of trading. I'm probably annoying some of you. What is that noise? What's he doing? I'm anxious because I've been in furniture stores all day with my wife. Oh, there you go. There's your algorithm. You got as far as, what's that, 4103 and even? What's the high on that? Yeah, 4103.00. Still could flip here. It would have been better had we started the run into the old intraday high at 410150. If it was doing that right when we got to 10 of 4, if it would have done that, then we would have seen that blistering big run up and pop through that 4104, 4105 level, maybe even higher than that. So at this point, you would be wanting to take just about everything off and to see if you can get another run on one singular candle. I'm sorry, not candle, but one contract. But this already is not in my favor for continuation. So what you do with the algorithm in the last couple minutes of trading, if you identify a liquidity pool that is likely to be ran out, which is what we were watching today, we were looking for this here. If it runs through it before 10 minutes of, then the macro will run through it aggressively and reach for liquidity that's resting above the high. But since we hit it ahead of and went through it ahead of, here, see what time it is? It's 3:48. That means it's already delivered running through the high here. So it's going to have a small little flurry. It might go up here, but then the macro will dig back into the daily range. Why? Why should it do that? In an up-close day, rarely, and it's not a trending day, but rarely do you see the candle close on the high, unless it's a trending day. Typically what will happen is it creates the intraday high today, then it pulls away from that high and closes near the high. So it won't be on the highs, it'll be off the high. So that's what that market on close macro is doing. Fair value gap right there, bumping up into the 41.75 level. If I was making the market, I would intervene here and rip it higher and go right into 4109. But that's just an ICT being an ICT. Yeah, she had me in all these stupid furniture stores. I can't stand looking at, like, I didn't need to be there. I mean, she could have went out there and looked around for all that stuff. What do you think about this? You know, whatever answer you give your wife, you know, if you're honest, you don't want the answer. And you don't want to lie and say, oh, yeah, it's great, honey, because then you have to buy it and live with it. So it was just miserable. Here's our 4104. Let's see if we can dig into 4105. Come on. Give me 4105 and 4109. Rip up there. Just because I'm asking nicely. Technically I'm satisfied because it did give me the 4104, which is what we were talking about. We're down in here. So that is a 10 handle run as well. Better than. In a very comforting Bob Ross tone, ICT has explained it in detail, what it should do, what it shouldn't do. If the market was not algorithmic, if there is no algorithm, I would not be able to do and explain what I just gave you. What logic am I using? Exactly. The more you know. I don't know if I'm going to be doing and spend some dead time. Erosion of my time. See that small little fair value gap? Since we went back below it and we had a run on the highs, respect it and reject and go down. Seeing does it give so it would allow me to feel still, but over time you'll get them. It'll resonate with you. It'll be that's the one. That may do it. Over time you'll get them. There's levels and rules to all this. It's not easy, I know, but over time you'll get them. And one of the things that I talk about and teach live and point out what it should do, what it shouldn't do, it'll resonate with you. It'll be that's the one. That makes so much sense to me. I'm going to use that, and you won't care whatever I talk about outside of that one. And that's what your model will be based on. All right. So now because we went above that fair value gap, you want to be measuring, does it offer support now? Does it keep price from wanting to go back down through it? Because if it goes back down through it, then we're probably done for the day and the highs in place at 4104. In that event, you would protect your stop loss. That would be somewhere down here. And you would close your trade. Otherwise, if it doesn't go through the fair value gap, and it's above it, you give it a chance to run up in there and see if you can make a higher high. But you want to be closing it right before 4 o'clock. Look at the time. I'd be done. I'd close the trade here, and I'd be content with that. Now, it can trade, obviously, past 4 o'clock. You want to venture into that time? It's your business. That's your prerogative. I just don't. See how we went through the fair value gap here? So even though I was initially right with the 4101.50 level and nailed it to the tick and reversed, I sat with you live and I told you another level that I thought would be significant for a daily high, 4104 as much as 4105. And if we were going to run through, I would have really appreciated seeing 4109. That's how I would have traded it. I would have looked for that type of run. As you can see here, that didn't manifest, but 4104 did. And when you would journal that and annotate your chart, you would put that in there. I'm pleased. I was so satisfied seeing that my analysis called for 4104.00 as a high. And then you take your little annotation and you dress up your chart, drop it on there, and then all your appreciation and self-love you pour into your journals and your chart annotations. You don't put anything toxic into it. You don't put anything, I got stopped out 2 times today and blah, blah, blah. You don't need to add all that stuff with misery. Because your subconscious is going to remember that. So, I do think that's going to be it for our time this week. I had fun. I spent a lot of time with you all, so I'm going to try to use this weekend to rest. I don't foresee myself doing the Twitter space this weekend. Usually Saturday, Shotgun Saturday, where I sit down with y'all and talk on Twitter. I'm going to use this weekend to rest. I'll send on Sunday evening before I've learned to quit compulsive OCD, correct something I miss. My mind's going 100 miles an hour while I'm watching real time. So one of the things I like about doing a live stream is it's one and done, or how I want them. This way, it's kind of like it communicates everything that's necessary. So I was trying to tell my wife, make sure everything's the way I want it, and then I gotta start the whole process of evolving into just doing this every day. Good now, Jack. That's what I wanted to say. I mentioned earlier, but I didn't finish the thought, or at least I don't remember saying everything to completion. But based on what I'm calling in Twitter or calling them, I don't want to know that because it builds variably. Because I am human. Like today, I have the big run today. So but don't add my handle on Twitter because I scroll through everything. I tell you those things disrespectful. Say thank you. Point of this entire year is for you missing the observations that are there without having the money, associated to laboratory experiments that we're doing. So I haven't looked at Twitter. So if you've tweeted, going through tweets, and it's the dad in me, the right way here. Tom Hugard, that I was going to give a review on his book. So I'll just do it briefly here. I listened to his audiobook over the span of 3 days. It's only like 6 hours or something like that. 6.5 hours, a little less than 7 hours. I enjoyed it. I thought it was a good listen. And if you haven't given it a consideration, perhaps you should do that. I'm not getting anything for it. I told him I was going to give a fair review, and if I didn't like it, I'd say it, but I would do so respectfully. But I enjoyed it. I told him, I said, I enjoyed your book. I had it through audiobook, which is the way I can go through. In some parts, I thought that, and talk about what they are, because then Peter did his audiobook. And you're probably asking, what do you listen to? Fiction, historical things, documentary type things. It's not always trading, but with 2,000 trading books, you don't need to have any more trading books. But what was interesting about this book is
2,000?
It was about how a trader thinks a trader, and his opinion about what we as traders should expect to encounter, how to deal with it, and how he dealt with it. And I find that fascinating. I absolutely find that fascinating. To me, that's more important than understanding how a trader trades with his techniques or skill set with whatever things that he uses in the chart. Because that to me is not of any importance. How they conduct themselves, how they manage their thought process, their emotions, their fear, their greed, their anxiety, their performance, and the performance anxiety that comes by way of doing what we do here. And I thought it was a good book. If it were a question of should you go out and buy it right now, I don't think it's a you got to go out and buy it right now book, but I think you should have it. And I don't think there's any book out there. Just a real quick follow up on what I was showing you on the Twitter space today. We have a low, higher low to the left of it, higher low to the right of it. Why am I using this one, not that one? Because this one went lower. So we have intermediate term low, which is a low that has a low that's lower than the previous short term low, and lower than the higher low here. So there's 3 points.
I remember doing this.
Okay, just like this is an intermediate term low here, this is an intermediate term low as well because it has to the left of it a higher low and a higher low. STL is a short-term low. LTL is a long-term low. ITL is an intermediate term low. Intermediate term low, short-term low, short-term low. In between two intermediate term lows is a long-term low. If we're bullish, we're expecting buy side up here, as I was yesterday explaining it live. Fib on this swing here and this here. Pay attention. First, I want to show you the settings. That way you can see this is my fib setting. I don't need this. I don't need this. This is to determine how far the daily range can come off its high or low and find a closing price. I'll teach that later this year. This is optimal trade entry levels. We don't need that, and I don't need equilibrium. So from the low up to the high, buy side is here. This high hadn't formed yet, so the first one past this high is 4101.25. Putting the fib on this low. First one past is 4101.5. That's the reason why I called 4101.5. That's this high here. The next one up is 4104.25. Let me take this off. 4104.25. So you can see we're at 4104.25. This low here to this high. So you would anchor it from low, drag it up here. Now because we have this high, which is relative to this high, buy side is what we're targeting above that. Drag 4104.25. So you can see we're at 4104.25. This low here to this high. So you would anchor it from low, drag it up here. Now because we have this high, which is relative to this high, buy side is what we're targeting above that. We can't use the -1 level. So the next one is what? -1.5. So 4104 even. And then this low here to here. We can't use this one because it's below the high here and here. Since this was higher, we have to refer to this frames the buy side now, whereas it was initially here until it bumped shallow. So the expectation is in the afternoon session, we're going to dig beyond that. So we can't use the first standard deviation. It's the next one, which is what? 4104.25 again. So there's 2 times at intermediate term lows and a long-term low, aiming for running the buy side. So 4104.25. What was the high of the day on Friday? Look right here. High of the day, 4104.00. No, it's not. I'm sorry. The next candle here, 4104.25. Right here on the candle at 6 minutes to 4. So 3:54 New York local time. The high comes in at 4104.25 to the tick. So what you're doing is you're looking for a confluence of standard deviations at key market turning points. This is institutional market structure. It's not in books. It's only been taught through my mentorship. And these are some of the components and things I'm going to teach more in depth about this year. And I'll have chapters in my forthcoming books. But again, you don't need the books. It's just for me to have it in writings. That way nobody can claim authorship. And ultimately how the market walked up into that buy side, into the 4104.25 level, nail on the high. The final hour macro, which is 3 to 4 o'clock, the last hour of trading before 4 o'clock closing session. Yes, it trades till 5 o'clock, but the bulk of the volume is going to be encapsulated by 4 p.m. 15 minutes after 3 to 45 minutes after 3, that 30-minute interval is a macro. And the algorithm will do a market on close run where it spools to a point of liquidity that had not been targeted yet, but would be the obvious one, that being the buy side here. Let me see that run from here. And I did a live stream. You can look at that. Go on my YouTube channel, click on live, and look at the February 10th, 2023 market review and live tape reading event, where I called every single one of these minute candles exactly as you see it delivered here and walked us up into 4104. So combine this with what I covered today in my Twitter space. I think you'll have a better understanding about what took place on Friday. Until next time, be safe. All right, just a real quick. Because it's ahead of CPI, our 3 levels for sell side liquidity. 20 some seconds.
Oh yeah, I remember doing this There's like an interactive Twitter space that I watched, and I literally went over and I think I already have like this annotated, but I don't know. I didn't annotate it this good, but I'm gonna go deep into this one, and then we'll go into the next day, and then the next lesson. I also want to go over the weekly profile. Oh my gosh. What element of time do we have here? that's why. It's just a stop hunt. I did this low. That 5-minute imbalance or 5-minute order block we're drawn into. Oh, did he note that? That was sus. Whatever I just did there, that was sus. I don't know if I've ever moaned like that. Low key, I'm not gonna put order block in there. Okay. Wow, what a beautiful day. NQ not so much. I mean, it's still a nice price action, but I think ES was a lot cleaner. There was no manipulation in London. Oh yeah, that's nice. (2022) model. $40 there to buy side. All that just for one day so far.
On my end for a delay, but you should be seeing the economic calendar. This is the Econo Days calendar.
Hold up. I'm gonna. See, I never had any of that.
And tomorrow is the day before CPI on Tuesday. This is the day that the market's going to get wrecked. It's going to be a mess. So you want to be very, very careful and don't participate at all on Tuesday prior to CPI. Now, after CPI hits, there's nothing wrong with going after whatever remains in terms of liquidity or imbalances. But prior to, you don't want to do that. Okay, you don't want to do that at all. So be mindful of that for this week and the rest of the week calendar. I'll talk about that as we go via Twitter. But Monday's kind of light, and because it's ahead of CPI, our expectations are not terribly elevated because of the news driver that will be on Tuesday, which is usually a one-shot, right away, one-way street. Just completely runs over top of the market. So just be careful with that. Okay, you should be seeing the dollar index. I'll wait until the live stream shows me that I'm actually on that chart with all of you. Yeah, it's not showing me the chart. Give me 1 second. Glad I checked. All right. So index weekly chart. Now, right away, one of the things I noticed first glance with you is we have taken out a short-term low on the weekly chart of the dollar index. We have overlapped entirely the gap that's between this candle's low and this candle's high. We have this large wick here. So midpoint of that, you want to annotate that for consequent encroachment. So it looks real close to this candle's opening. I'm just going to roughly eyeball it. So around 104.80 to 104.85. I mentioned how we had, I'm going to try to keep my charts clean and just talk about specific price points. So that way you can annotate your own charts instead of just using mine and being content with that. I know some of you are mad about that now. So we came back down inside this buy side imbalance, sell side inefficiency, this candle here. And we've already completely overlapped the weekly gap. So we have buy side here, an old volume imbalance here. So this volume imbalance, this buy side liquidity pool, and the weekly consequent encroachment level on that weekly gap high. Those three levels are my premium arrays that I'm watching going forward for this week. The discount arrays for the dollar is the consequent encroachment of this wick here. Now, let me remind you, I do not know where the market opens on Sunday. No one does. That's a complete mystery. So we all have to wait and see how the market itself starts its week. Whatever that new opening price is on Sunday, that's when we have the data to start working with it. Right now, we have no idea where it's going to open. So I have to give my students, and I have to record my observations, both premium and discount. I cannot frame a narrative. Now I'm going to share with you what I think might happen this week. Don't read that much into it because it's before Sunday's opening. Right now it's 10 minutes or not, 10 minutes or so before 10 a.m. Sunday morning. So we have hours before the market actually opens up. But I'm hopefully inspiring you to look at both sides of premium and discount. And then when we open up, what do we gravitate towards? And then obviously keeping our expectations low on Monday because the CPI number that comes out on Tuesday, that's the real carnage. That's the move. 10 minutes or so before 10 a.m. Sunday morning. So we have hours before the market actually opens up. But I'm hopefully inspiring you to look at both sides of premium and discount. And then when we open up, what do we gravitate towards? And then obviously keeping our expectations low on Monday because the CPI number that comes out on Tuesday, that's the real carnage. That's the move that's going to do a lot of the violence. And I'll give you my opinion what I think might happen. I've been wrong a lot with CPI. When I try to forecast what they're going to do beforehand, that's why I don't trade ahead of it. Because if I had a method to trust what it was going to do beforehand, look how fast it moves. It's typically moving anywhere between 50 to 100 plus handles when it's released. So when the market absorbs that CPI data, it's just like, wow, it goes and just immediately rips. And you don't want to be in that on the wrong side. So do not try to trade ahead of CPI. It will hurt you. So the discount arrays for the market, which is below market price, we're assuming if you look at the chart right now and it was live data, market price, the closing price right here is 103.578. So below that price, we have this low for sell side liquidity. We have the buy side imbalance, sell side inefficiency, consequent encroachment, which would be here, which is also pretty much the consequent encroachment of this wick, the midpoint of that wick. Okay, and we have a volume imbalance down here. So make sure those are annotated on your chart going forward. As soon as the market opens up on Sunday, you're going to make a measurement of the midpoint between Friday's closing price, wherever Sunday's closing price is, and the difference between the two. That's consequent encouragement for the new week opening gap. You'll do that for every market that you follow. If you're Forex, you're going to be doing with dollar index and whatever Forex pair you trade with. Since I'm teaching predominantly with the medium of the E-mini S&P this year, we would be doing that with the opening price on Sunday in relationship to Friday's closing price on E-mini S&P, and then splitting that range in half. And in that entire range, there's 3 specific levels. We carry that all the way through till Friday's close, because the market's going to refer back to it, as many of you already discovered. That's a true statement, and it repeats. So there's the levels for dollar index I like, and we're going to go into euro. All right, so I kept some lipstick on this, and I didn't want to have it on there. I apologize. So you can see what we talked about before and the reactions thereof. So buy sell liquidity pool, they swept that, took it up into the fair value gap I mentioned. If we get above here, it can expand up into that. Go back and look at January's commentary on my YouTube channel. I can't edit it, I can't change it, I can't make it look good for me now. It's there, it's been there. We went up into it here, we broke down. Small little fair value gap in here, which we repriced to here yesterday, or Friday rather. We had a nice displacement lower. You want to carry that range out, because if we go through it and come back up, it may act as resistance, the low and the midpoint of it, consequent encouragement, which is based on this candle. Right here, the 9th of January. January 2023. So that daily candle is your fair value gap on your daily time frame. If we accelerate lower with higher dollar, sell side's the next draw on liquidity. You want to use the consequent encouragement of that wick as well. So it could come down here, just fall short of it, assuming, but I'm taking a great deal of liberty by saying if it does go lower, because that's pretty much already indicating what I'm expecting. I'm expecting higher dollar. I'm expecting lower prices on other assets like equities and Forex, foreign currencies. So if we do break lower and we get this weakness, midpoint of that wick right here, consequent encouragement, it could drop down there, not take out that low. So in your notes, anytime there is a short, stubby little wick, okay, and what do I mean by that? It would look like, look how big the candle is here. Let me zoom in a little bit. Okay, see how long this candle is, and then how little the tail is, the little wick? That to me is a very short, stubby little wick. In relationship, how am I basing whether a wick above a candle or below a candle is stubby and short? It's relative to its candle size from high to low. So that way there's your reference point. Versus something like this. So you have a long wick, and it's the majority of the entirety of the candle. See that? So in relationship, this tail or wick on the low of the candle is short and stubby. And many times you're going to find, this is what you want to have in your journal and in your study notes, many times that type of low will get probed without going through it, and it'll stop at consequent encouragement for it right there. So I'm giving you a visual of what I'm referring to. It could drop down, come right to it, or just below it a little bit, and then retrace, and then at a later time come back down through it. Whereas a long wicked candle, generally, if you're on the right direction, in other words, if you're looking at a wick like this and you're bearish, many times it'll go right to consequent encouragement and stop dead in its tracks and go the other way. Or if it's really weak, it'll only go up like 1/4 of the wick, stop right there, not even go to consequent encouragement, and then drop. The instances that it does that very thing, that is a real hardline indicator that you are in a very bearish market. Because generally you want to see the algorithm reprice back to consequent encouragement of a wick. If you're bearish, if it's a very, very long wick like that, consequent encouragement, which is the midpoint of the long wicked gaps, they're barriers. But if it can't even reach that while you're bearish, and it goes to the quarter range of the entirety of that wick, not the full body high and low, where the wick is generated from the high down to, in this case, because it's a higher closing candle, you'd be using that closing price too high. And those relationships will serve you well if you go forward. The other thing I want to teach about this morning for wicks is when you have a area where the candles create a wick, like for instance, like right here. See that? The body comes down essentially to the old fair value gap high there. In the next candle, we open here, We trade back down to the body of the candle. I'm sorry, the opening, or the high end rather, of the fair value gap on this candle right here. I'm trying to be mindful of keeping my mouse still because apparently when I'm talking and my mouse has already moved. So there's a little bit of a misalignment from the live streaming. So it's something I'm trying to make a conscious effort of remembering. But we have this wick on this small little down close candle right here. The next candle, when it opens and trades up and comes back down, if we have this candle here go up to what would be almost essentially the midpoint or consequent encroachment of the next candle, we don't even know that it's going to create this pattern. But we don't know it. But should it form that, generally you will see the consequent encroachment of that wick. If it's bearish, it won't reach it, and you can see that happening right here. I'm not cherry picking that. I'm showing you to go into your charts, and you'll see that is the case. Because this candle here is a precursor. Then you get the actual wick here that's on the high. And when you see me sometimes taking live executions and I'm entering trades, I'm sometimes using that very criteria right there. And trusting that as I'm seeing the candle open and it trades right up to that point here, I'm trusting that it won't even go through consequent encroachment. I'm not fearful of it because it's that type of signature I'm looking for. It's kind of like justify the confidence behind the idea. So anyway, we have the order block here. So that high, which is the level that's already being shown here, make sure your fair value gap is noted. So if we go through the low end of it, which is this candle's high, so this candle's high on the January 6th, if we trade through that to the downside here, I'm expecting the low of that rectangle, which is the high of that candle here, and consequent encroachment, which is the midpoint between January 10th's low and January 6th high. So you would split that in half for consequent encroachment. So I wouldn't want to see it trade back above that level. If we go below it, leave that range and then come back and touch it here, or go as deep as, but preferably not, the midpoint of that fair value gap that's shaded in blue. And then I would look for a run into this wick and or consequent encroachment. Now, if we do take out this low, go over here to the left, there's no imbalance in here. There's just a small little sell-side liquidity pool here. There's really no balance in here. I'm sorry, no imbalance here. Nothing in here because this high is pretty much this low. This candle's high is pretty much this candle's low. There's no imbalance in here because it's completely overlapped this. So the next period of liquidity would be here. My interest would be there. So am I saying that it's going to be a straight crash down there? No. But I'm thinking if we do get below this and we start respecting all of the premium arrays, and anything that would be considered bullish keeps getting broken to the downside, which is what institutional order flow entry is all about. We want to be looking for those types of things, supporting it. So order flow needs to be bearish in arrays. And anything that would be considered bullish keeps getting broken to the downside, which is what institutional order flow entry is all about. We want to be looking for those types of things, supporting it. So order flow needs to be bearish. And when I taught on, no, I don't remember what day it was I was teaching. It was in the Twitter space yesterday, where I'm talking about order flow. When you're going lower in price and you're expecting it to deliver to a discount objective or target, you're looking for up close candles to provide resistance, and any fair value gap really keep price at bay from going higher. And you want to see the low of the fair value gap or consequent encroachment be the defining boundary for any kind of retracements. And then once it gets to those levels, you want to see that it sharply moves away with speed. It doesn't like to hang around there. If you have those signatures while you're watching price print lower, you are watching a sell program deliver, and order flow is bearish. You don't need trend lines, moving averages, depth of market, ladders, volume profile, none of that stuff. You don't need any of it. And you're just reading the actual high, low, and close price and the feed that's being delivered real time. So we could be seeing a surge in dollar. We could be seeing a decline in foreign currencies and equities. There's a lot of saber rattling. I'm not going to talk too much about what I mean by that, but if you just look at the headlines, certain countries are making pretty bold claims about what they're going to do in retaliation to certain things that other countries have done or implying that they have done. And that is a cause for concern, and that's going to cause what? A risk-off scenario. Risk-off means it's going to be a flight to quality, and I'll let you come to the conclusion if you think the dollar is quality. But generally what that means is risk-off is the dollar gets bought up. So higher prices in dollar will pressure foreign currencies. So even if you have a buy signal in Forex pairs or equities or index futures, in those conditions where dollar's rallying, it's real hard for those markets to get traction. They might rally against it for a short period of time intraday, but it's usually short-lived, and then finally it'll just be like, wilt, and it goes the other direction. In relationship to a higher dollar, everything else usually drops. And it's that teeter-totter effect. One goes up, the other goes down. So it's a back and forth type of balance. But don't think that it can't, in intraday price action, move in tandem for a very brief period of time, which can be confusing for a new trader or someone that's expecting it to be lockstep, where every little tick up in the dollar sees every little tick lower in index futures or equities or Forex. Sometimes you'll have that little crack in the correlation where it can be confusing, which is why you want to have intermarket relationships and analysis in your trading. Like, I don't trade the Dow. I can't stand that. I can't stand that index. It's just too spotty. I don't like it. Okay. It tends to overreact more sporadically than the NASDAQ, where NASDAQ can overreact and overdeliver versus the S&P. S&P tends to be much more smoother, more well controlled. Let's put it that way. Smoother, doesn't have as much erratic over-exaggerations in price. Dow can be like that. But also it can do things in ranges and chop around before moving in tandem with NQ and or ES. So that's the number one reason why I get asked a lot, why do I not want to trade that one? It's because it has its specific characteristics that I don't favor. You might like that. You might be able to trade in the Dow, and because you're hearing me say I don't like it, if you're successful trading it, don't change. Don't let me influence something that's already working for you. But I'm answering a question, and I don't want to be crucified for my opinion and or the reasons and decisions why I do something or don't do something with a particular market, like crypto. I have no interest in it. So I try to be as hard and bold about not liking it, so that way people don't ask me, because I get asked all the time, like synthetic indices. I don't know anything about them. I've never had any experience with them, and I don't know how the Nifty 50 and the Indian markets. I don't know anything about them, so I have no experience. So I won't talk on it because I don't have any experience. But the things I do have experience, I'll share my opinion with you. But I think that we may be seeing, because of all the things that's going on, and we're talking about ET coming now. Foo Fighters are all over the place getting shot down. There's a lot of weird stuff coming out, and the more pettier factor is obviously WA. Are you paying attention? And you need to be mindful of that because it's going to have an impact on a market, every market. So real quick, I'll do GBP and then we'll get into the business with ES. All right, so here is pound dollar, and let's assume for a moment that I'm correct. I don't know if I'm going to be correct, and you shouldn't assume that I'm going to be by default. But let's assume for a moment that dollar does in fact go higher, and CPI number causes the dollar to rage higher, and index futures to drop hard, forex pairs to drop hard against the higher dollar. That would, in my mind, lead to a potential run on cable below this low and below the sell side here. We have this imbalance here that we didn't come all the way up into. I like that. I like the fact that we couldn't even come back to this old low. Remember what I was saying earlier about the relationships of the wicks in the candles. When they fail to reach the midpoint of the wick, and they're it's a high, for instance, something like this. Okay, you're looking at that type of candle. And if you're bearish and the next candle tries to get up there but fails to get to even the midpoint of it, which is consequent encroachment, that indicates that you're really bearish. And the same when I look at a gap, like this sell side imbalance, buy side inefficiency, which is a fair value gap. By classification, the PD array is fair value gap. What kind of fair value gap? A sell side imbalance, buy side inefficiency. SIBI is what I usually abbreviate it in my charts. It's sell side imbalance. That means it's all one-sided, one big candle going down. It's lacking efficiency on the buy side. In other words, it needs to be offered at a later time with movement higher by price. The difference between this candle's low, come back to this one, and we're talking about ET coming now. Assume for a moment that dollar does in fact go higher, and CPI number causes the dollar to rage higher, and index futures to drop hard, forex pairs to drop hard against the higher dollar. That would, in my mind, lead to a potential run on cable below this low and below the sell side here. We have this imbalance here that we didn't come all the way up into. I like that. I like the fact that we couldn't even come back to this old low. Remember what I was saying earlier about the relationships of the wicks in the candles. When they fail to reach the midpoint of the wick, and they're it's a high, for instance, something like this. Okay, you're looking at that type of candle. And if you're bearish and the next candle tries to get up there but fails to get to even the midpoint of it, which is consequent encroachment, that indicates that you're really bearish. And the same when I look at a gap, like this sell side imbalance, buy side inefficiency, which is a fair value gap. By classification, the PD array is fair value gap. What kind of fair value gap? A sell side imbalance, buy side inefficiency. SIBI is what I usually abbreviate it in my charts. It's sell side imbalance. That means it's all one-sided, one big candle going down. It's lacking efficiency on the buy side. In other words, it needs to be offered at a later time with movement higher by price. The difference between this candle's low and this candle's high frames that SIBI, the sell side imbalance, buy side inefficiency. The market tends to want to reprice back up into the range and as far as the previous candle's low. If we see something like this, I like that. I like to see it in my intraday charts, in my intraday charts for my intraday trades, and it's just what I'm expecting to see price do. I like the fact that we did this here, but we have to be mindful because we went simply below this Thursday's low, and we closed pretty much right at it, or well, let's look at the difference here. The low is 1.20572, and the close, yeah, we're just above the close, but essentially almost the close is just a little bit above the high. I mean, the low tick of this candle here. I would have been warning you, saying that we close down below it, and that doesn't necessarily mean it's going to be immediately lower. Because I see this, and this is what you want to write down in your notes too. Be very careful about what I'm about to say. Because I'm giving my opinion, and it's before Sunday's gap, well, before Sunday's opening, I don't know if there's going to be a gap. It can open relatively unchanged, and that would be expected, frankly, because CPI is on Tuesday, and the market's going to be not terribly interested in doing a whole lot before that because that's the main event. That's the big ticket event for this week's CPI. Everybody knows that's been trading that CPI is that tornado. It's that tsunami. It's the
wow, look at this delivery.
weapon of mass destruction, okay, where the market just simply gets destroyed immediately, and anyone that's in the wrong side of the marketplace will get hurt. So because I'm expecting that carnage on Tuesday, like every other trader is, Monday's trading probably will not be all that eventful. I could be wrong, but I don't suspect there's going to be a whole lot of movement ahead of CPI. Can you trade on Monday? I believe you can, but I don't want you to think massive big range unless they start shooting down all kinds of Foo Fighters, and then it's all over the news. And it's probably going to cause all kinds of weird stuff to happen then. And I'm being obviously facetious when I'm saying that. But if we're expecting lower prices, the best signature on Sunday's opening would be a gap
19.
Lower opening, and then a rally back up into it overnight or into Monday morning, and then does it show a willingness to want to go lower? If it does that, and we're leaving gap lower opening, and then a rally back up into it overnight or into Monday morning, and then does it show a willingness to want to go lower? If it does that, and we're leaving like intraday lows on Monday that are relatively equal, and then we roll into Tuesday and those relatively equal lows are still there on Tuesday ahead of CPI, then I'm going to feel further emboldened that that's where CPI is going to rush through, and then dig into something like this low here, causing dollar higher and pound getting wiped out below that low right there with a large range on Tuesday. So that's what I'm doing generally on Sundays. Well, not Sundays. I usually do my analysis on Friday nights late or really, really early on Saturday before everyone wakes up. And I'm not spending as much time as I'm doing. It takes more time for me to talk and articulate how I think, which is why you're listening to me. As much as sometimes you guys complain about me jawboning and going on and on and on, I have to justify why I'm saying what I'm saying, because if I don't, I have 1,000 questions. And then people email me and they text me and they send me messages through TradingView and they're angry. You're not answering my questions. And I take that to heart. I don't want to come across as someone that's not willing to answer your questions. Right? I'm only one person. So I try to do as much as I can in my dialogue to try to circumvent the need for you to want to raise your hand for a question, because 90% of the time you're going to hear your question that you have. If you write it down in your journal, it'll get answered in the normal process of going through. Now that we're doing it daily and we're doing it live now, chances are you're going to get the immediate feedback that you're looking for. You just have to be patient. It's not imperative that you get your question answered right now. As much as you feel like it needs to be answered when you have it, you don't. Nothing is that sensitive that you need to know right now. Okay, it's better for you to adopt a mindset and patience, forge that patience and discipline, because you're not going to get the immediate feedback you're looking for when you take your trades. So you might as well condition yourself for that. Okay, I might be a source of frustration right now, but the market's going to provide you even more frustration because you're showing you're impatient. And when you put a trade on, it's not moving for you in your favor. You're going to feel that same impatience, but it's going to be worse because your money's on the line. Whereas right now, you're learning. You're not trying to risk any money right now, which is the best way of learning. So I'm looking for, in my mind, a lower gap opening on Sunday. But because of, this is important to write this down, I'm looking for patient. Okay, I might be a source of frustration right now, but the market's going to provide you even more frustration because you're showing you're impatient. And when you put a trade on, it's not moving for you in your favor. You're going to feel that same impatience, but it's going to be worse because your money's on the line. Whereas right now, you're learning. You're not trying to risk any money right now, which is the best way of learning. So I'm looking for, in my mind, a lower gap opening on Sunday. But because of, this is important to write this down, because CPI is the big event on Tuesday, it isn't really needed to see a big gap lower opening. It might be relatively close to where we closed on Friday, indicating what? When I see that, if I see that, then I think that Monday will be really quiet and we're going to be waiting for CPI. And that's a reasonable forecast. That's something that anybody technically would reasonably expect to see in price. And why? I just explained it. But now watch what happens. If we see a gap lower that's big, that creates a really good trading opportunity for Monday, even though the big event is on Tuesday. Why do I say that? Because the difference, I think that Monday will be really quiet and we're going to be waiting for CPI. And that's a reasonable forecast. That's something that anybody technically would reasonably expect to see in price. And why? I just explained it. But now watch what happens. If we see a gap lower that's big, that creates a really good trading opportunity for Monday, even though the big event is on Tuesday. Why do I say that? Because the difference between where we closed on Friday and where we gap open on Sunday, if that's a large gap, on Monday morning, there will be a tendency for that market to want to rally up into the range that's created by the gap difference of Friday's closing price here and where we open. And I'm actually talking about S&P while I'm looking at the British pound, but it's okay, it's fine, because even though they are different, they're going to trade sometimes very similarly because of risk on, risk off factors. So while we won't necessarily see the gap the same way we would see in S&P, because if you toggle, and I'll show you when we get to the S&P, but there's no way of toggling like regular hours and electronic hours for Forex. It's always the same thing. Once we start trading on Sunday until we close on Friday, it's all continuous delivery. So you have to look at gaps and separations between trading sessions differently. And I'll teach you more about that as we go through this year. But if there's a gap in ES, like I taught you last week, and my private members are aware of, this is how I teach the indices market. You need to be considering what we did the previous session, how we closed, and where we opened at 9:30, because that difference, that is a real liquidity void. Gaps and separations between trading sessions differently. And I'll teach you more about that as we go through this year. But if there's a gap in ES, like I taught you last week, and my private members are aware of, this is how I teach the indices market. You need to be considering what we did the previous session, how we closed, and where we opened at 9:30, because that difference, that is a real liquidity void. Write that in your notes. Okay, the PD array that opens at new day and at new week, they are liquidity voids because there's no trading that took place at all. So to answer a lot of questions I've been getting, what are those? They're named obviously new week opening gap, which is the difference between Friday's closing price and Sunday's opening, regardless if it's a higher opening on Sunday or lower than Friday's close. The difference, whatever that is, that's new week opening gap. As a PD array, a very specific element of price delivery, it is a liquidity void, a real liquidity void. This right here has been unfortunately labeled inappropriately as a liquidity void. And I've used it because of the people that were talking to me on Baby Pips. They used that term, and without me trying to confuse them, I just went, okay, well, we'll just call it what you call it. But it's not. It's not a void. There was buying and selling in here. There absolutely was buying and selling. Even though it was a down closed candle, what it is it's a sell side imbalance, which means it was primarily too much of one-sidedness going lower. So the algorithm will want to reprice to offer fair value by going back up like it does here. The fact that we didn't come all the way back up to that area here and close into this candle's low, to me, indicates that that is weak, decisively weak, because of the same characteristic I taught you with the wicks. If we can't climb up to the midpoint of a wick above candle and we're bearish, that is extremely indicative of a lower moving market. So it's those types of things that I'm weighing as each candle's forming. And you'll hear me talk about it when we're doing live streams. I'll say, this is interesting to me. This is what I'm wanting to see. I don't want to see these types of things. If I say something like, okay, I don't want to see that right there, that's not surprise. That's not me afraid that the market makers are going to move on me. That's not me thinking, oh, they just changed the algorithm. It's just something I don't want to see this right now in the context of what I'm looking for. And I have to see it have a resolution to that immediately. And it'll make more sense as you watch me do more of it. But I'm not ever looking at price saying, oh my goodness, where did that come from? That's always a possibility when you're reading price. I'm never going to be surprised or shocked. Now, I would be if we were in a market and I'm expecting price to deliver like it normally would. And for a non-CPI day, and it creates a CPI run out of nowhere, boom, that's a black swan. Then you will hear me say, what the, I'll go off the rails, because it would be completely unexpected. It would be completely untradeable. But barring those instances, which is always a risk, that's why I tell you all to learn how to do this in a demo. I never encourage you to go into a live account, because those very instances are what we're moving into. We're going into very hard times. And the market right now, you're learning how to do this in the most difficult time. Do you know someone other than me that is an online personality that's a trader? If they've been trading longer than the last 3 years, ask them what their opinion of what the market conditions are right now, and how does it relate over the entire spectrum of their experience as a trader. If they're honest, and if they've been trading for a long time, I guarantee you they're going to tell you this. These markets right now are very, very difficult. It's not because they or myself are poor as a technician or a trader. It's very difficult right now. And for a new student coming in, you have no appreciation of that. You have no appreciation for what it takes for someone to be able to sit over the charts with you, whether it be me or anyone else, and convey with a great deal of conviction what the market's likely to do, because we are working very diligently to try to come to the conclusion of what these markets are trying to arrive at. And I've made no bones about it. I've been very candid about it. In fact, I've dialed my trading back so far. I've not had this little bit of engagement since we started all this stuff in 2020. 2020 caused me to put the brakes on a lot and slow down a lot. So to keep myself engaged and not lose my focus and my effectiveness as a technician, I'm working with you as a community. I'm showing you what my analysis is calling for. I'm doing executions. I'm doing live streams now. I'm calling every individual 1 minute candle. So it keeps me focused, because if I spend too much time away, which was what my concern was and why I stayed continuous through the holiday break too, because I know these markets are very difficult, and at least I'm staying very close to the rhythm of what it's doing. If I stayed away for 2 weeks or so, I would be rusty. I'd be like a boxer that hadn't been in the ring for a couple months or up to a year. Yeah, you don't want to get hit by that guy, but someone that's been active, they're going to be more reactive to their punching and be able to slip their punches. And you don't want to have that kind of ring rust, especially trying to do this on the live stream. So anyway, I say all that to say that I do believe that CPI is going to be probably an instigation to a higher dollar and a lower factor for like index futures, stocks, and Forex. That's my opinion right now. That can absolutely change based on what we do on Sunday's opening. I mean, we could see something happen between now and Sunday's opening that causes a geopolitical, wartime response, and everything that I just said is completely undermined, which would mean nothing because I'm not trading on Sunday. So these are all things that you need to be aware of. And some of you are coming into this thinking that you need to know, and you must know, otherwise you don't know what you're doing, or I or anyone else doesn't know what they're doing, if we can't predict the opening price on Sunday. No one can do that. So stop placing that emphasis on you as a student learning how to do this, because the markets are not going to be consistent in that regard. You have no idea where they're going to open, just as well as I don't know where they're going to open it up at 6 o'clock every weekday when we have that 1 hour close between 5 p.m. New York local time when the index futures stop trading, and when they reopen at 6 o'clock, I have no idea what price they're going to open up at. Now, I can teach you, as you'll learn, how they're likely to gap it lower or gap it higher, but I don't know what price they're going to open it up at. And I don't know what the immediate response is going to be when they open it, because they could be opening with a gap lower and then run away real quick and leave the gap opening for a day. There's nothing saying that it has to reprice back up to that gap and fill it immediately. But some of you are thinking simply because there's a gap, oh, it's immediately, let's go right there. And that's not how it works either. There's a lot of things that you have to weigh out. And that's what makes this difficult as an educator, because knowing what you are expecting, I already know 90% of the questions you're going to ask. As soon as I say something, or before I say it, that's why I pause. I'll take a deep breath, because I'm taking in from experience. I know what I want to say, but I also know by experience when I say certain things, 50 questions are going to mount up in your mind because of what I'm saying or did not say in that sentence. So I try to be very inclusive in my delivery of whatever I'm talking about. And I'm trying to be very careful and think about the words I'm saying, so because I don't want to waste my time. As much as I feel like most of you that are impatient feel like I'm wasting yours when I'm doing these types of deliveries. I'm trying to be thorough. I'm respecting your time and attention. I'm giving you every facet of my experience within the context of every response or lecture. And that's what you would want, not some lazy, half-ass approach that, well, you do this, you do that, and you should know how to do it after I've done it said one time. That's inefficient as an educator. I wouldn't be satisfied with that. I would want someone that wants to explain things in the minute details and the little subtle nuances that go along with it. And because if I give you a delivery about an idea or a concept, just look at the comments immediately. Well, why didn't you look at this? And what makes you think that? When would you not want to do that? And that's why I talk a great deal about one thing, and I build on the reasonable questions that I know are going to come as a response to me saying something. And you want to have that from your teachers, whether it be in trading or anything else. You want to know everything that they're willing to share, and that's all I'm trying to do. So let's go over to ES. All right, so here's the daily chart. And some of you are probably thinking, well, why didn't you go on lower time frames? Number one, I don't have 4 hours to do today. And I know a lot of you are ready to eat your potato chips and drink your beer and yell at the screen about guys throwing around a piece of rawhide and hurt themselves on a predetermined outcome because there's so much money on this game in Vegas. But that's another discussion. It's rigged. So if we look at the daily chart of the E-mini S&P here. Let's just go up to the weekly chart. All right, so we have a swing high that's formed after taking out this high. Excuse me. We did go above these relative equal highs, which is what I mentioned was the draw on liquidity when we were down here. We ran up through that here on Thursday. We challenged it on Friday, and they said not anymore today. So we had a little bit softer close on Friday. We could not get down to the encroachment of this daily candle's wick. Note that, okay? So on your daily chart, you're going to have these levels and carry them down into your lower time frame charts. I'm going to allow you to elect whatever colors and thickness and all that stuff. I'm not trying to influence that, because when you do your own annotations and you do your own charting, you need to bring your own personality to it. Stop trying to mimic me. What's your colors? What's your candle color settings? Be original. Let it be a manifestation of your own individual personality. You will enjoy it more versus me trying to press you into a mold. Copy me. I don't want a copy of me. I'm interested in seeing how you take this information and become your own trader. And I would love for you to be doing what I'm doing now, and I could listen to you and watch you grow as a trader. Like I want to see that in my students. Some of you don't want to do that. That's fine. I'm not encouraging the ones that don't want to do it. I'm just saying I like seeing the independent thought process of all traders, not anybody that's always just a student of mine. I like the guy Pat Whelan. I like Trades by Matt. I like Tom Hugard. I like just about anybody to be willing to live stream. If they're willing to put their time out there, I like watching because I want to see how they think. Well, in your annotations, you want to bring that to your charts the same way. Your own approach to doing it. Your color scheme, the way you annotate, where you put your notes, what you're looking for. I'm going to share the levels that I'm looking at here. And I review this as these are key to me going forward. If you have other levels besides the ones I'm showing, don't erase them. They're pertinent to you, what you're observing. The trades that I'm going to see and take this week may not be the one.
Ain't no way he's live right now.
Good morning, everybody. This is the new setup. I would be. Why is this so important? Well, that's the reality. The high could already have been in if I used the high just beforehand, because it's so marginal, and I just want you to be aware of that. And there's also the third option, is that I'm completely wrong, just plain wrong. Maybe the market is going to go up forever.
Ones that you take, and you would be terribly misguided by me if I said only try to do what you're seeing me do. So in your annotations, just at least have what I'm showing you in addition to whatever else you see that is useful to you. You may be observing something that you need to see subconsciously have a effect on price action. And then when it happens or doesn't happen, that moment of insight that you don't know how you're going to respond to may be that very thing, that epiphany that puts your understanding about what it is that you're looking to do as a trader right to the point where now you know what you're looking for. So I'm trying to be very careful not to undermine normal creative development, because it's easy. It's very, very easy for me to derail someone that already knows what they're doing. And if you don't believe that, if you're on Twitter right now, if you have been affected by me talking about my opinion while you're in a trade or about to take a trade, and then your trade would have panned out if you just would have ignored what I said, say, I saw that, I've experienced that. It doesn't mean that I'm less of a trader or I'm better than a trader or either or. It just means that you don't want to have anyone, me at the top of the list, to influence anything that you're testing out, anything that you're trying to do, case studies on, real-time walk forwards. You don't want that to ever be skewed, and I don't want to be a detriment to your development. So if anything in your annotations that you're doing is different from what I'm about to show you, and yes, this is important, stop bitching, because I know some of you are like, get on with it. This is important. These are the struggling points that real students that trade with real money now sometimes have that impact by me saying something, or if I'm pulling up a level, they second guess themselves. I said, well, maybe it's not what I should be looking at, because ICT didn't mention that. And they're in a trade. They have money on the line. And I now subconsciously affected their ability to hold on to that trade. Not because I don't even know they're in the trade. I'm just giving you my opinion, which is why I constantly remind all of you as students and viewers, you can use my concepts and be trading a different direction in the same instrument, and we both can be profitable. It doesn't sound possible, but it is just like that. And you won't experience that until you get well-rounded and you have your own experience at the end of the your setups, and you said, well, wow, he did that today, referring to me, and you did something entirely different, and we both saw outcomes that were positive. But if you are affected by me in my analysis or my key levels, just keep what you trust in your charts, but don't negate having what I'm going to show you. That's all I'm saying, okay? At least have this much. Anything additional is just for your own observation, and that's wonderful. I don't need you to share that with me. Okay, I get a lot of questions by people tweeting to me. What do you think about this? Did I do this right? Did I do that? What's the outcome? Was the outcome favorable? You need me to tell you that was a good thing? If it's good, it's good. I mean, it's simple. Don't rely on me or anyone else to co-sign your observations. You need to be confident and trust the fact that you're doing this on your own, like trading is going to always be. So just be careful not to be influenced by me not saying what you see in your chart. If I don't say it, doesn't mean it ain't valid. It just means that I'm not worrying about that right now. I have something else I'm looking for that would set up a setup for me. The analyst in me sees something that I want the trader, Michael, to engage in this week. And these are the levels that I'm watching. That's all I'm going to say. Okay, hopefully it's been communicated fairly without offending anyone, and hopefully bringing some calmness to those that have experienced it, because it's not my intent or interest to try to disrupt your learning. So with that said, on the ES, on the weekly chart, we have consequent encroachment of this wick. Make sure you have that noted. Even though we've gone above it here with this candle's high on Friday, keep that consequent encroachment on that wick right there and add this one. Be mindful of the opening and the high of this down close candle here. Extend that out in your charts. Now, as a way of differentiating any levels that I have on one particular chart I have in my array of monitors in front of me, anything from a monthly or weekly time frame, I use the biggest, boldest line. I think it's the number 4 setting on TradingView. That way I know when I'm looking at them, that's coming from a weekly or a monthly level. So when I see it, I know there's going to be a whole lot more emphasis placed behind it. Because if you just simply put a regular thickness and the same color scheme across your charts, you might lose sight of what that level is. Because while you're learning, you're probably going to have a whole lot of lines on your chart. And over time, you'll find that you'll be using less. You actually have a pad next to you like I have, and I have key levels written down numerically. And I write them down in an order like a PD array matrix, in the order where I am in the marketplace. And I write above that price. Like at opening prices, I'll give you an example of what I'm talking about. At the opening, at 9:30, I write down physically the opening price on a little yellow notepad. And you've probably seen them sitting on my desk when I panned around the other day on Twitter and showed you my stuff the very first day, Tuesday, when we did our first live stream. I write down the opening price. That space that I wrote it down in is empty. But above that, I have several levels that I wrote down that were pertinent to a weekly high or a weekly low or something like I just outlined here. So I'm constantly referring to where we opened in relationship to these key levels here. So you're going to learn visually by having the levels on your chart. I don't need that part anymore. You won't, in the future, you won't need it either. You'll just have those levels written down in your notes, and you'll just glance through and say, okay, these levels are key. It also keeps your charts clean, and it keeps you from wanting to do what? Toggle through time frames. Toggling through time frames can disorient you, especially if you're new. If you lose sight of what chart you're on, I can't tell you how many times by answering questions when I was in live sessions teaching in my private group, my old students, I would be looking at time frame and get disoriented because I'm going back and forth between two different markets and forget what time frame, and I'm looking at something and I'm giving my delivery about this is what I think is going to happen, and it's not even a time frame that would be useful for that idea. Like I'm looking at right now a weekly chart. If I'm not careful, I could have went right into describing this as this is what you want to see on the next day when we're on weekly candles. So by having things written out numerically and in relationship to how each one of those prices stack up from high to low, where they fall in the grand scheme of things, I have that as my reference point. I refer to that more than anything that I do while I'm in intraday price action. I'm constantly looking at, okay, I'm looking at this right now and I'm on a 1 minute chart. I'm looking at that and I'm referring, how are we in relationship to these levels? Once I hit a level, like when I just gave you these levels here, once they're traded to and they're touched one time, they're booked, I circle the price level on my notepad. That means I know we've hit that already. So if I need to refer to it the next day or on Thursday, I know we've already went there before. So if it's going back up there and it goes to a level I've already circled, I don't need a level on my chart to see that, oh yeah, we ran. I do that for your learning, so that way you can visually see it's ran buy side there. So I'm thinking, okay, it's ran that. What's the next level of interest above that I haven't seen be booked or printed yet? And once I see that, then I know that it's likely to go through that level into the next level I'm interested in above it, if I'm bullish. So I'm trying to give you an idea of what it is I'm doing. Because I taught myself this because that's essentially what floor traders do. They give you the pivot numbers. They ran their pivot numbers on the night before, the open, high, low, and close. Times 3 minus the the low price and gives you the high price. The whole formula that gives you pivots. And then I'll take those pivots and divide them in half. So it'd be mid pivots. So if you have like R1, R2, and then central pivot, I would have central pivot to R1, and you're probably completely distracted and confused right now because you don't hear me talk about pivots. It's not terribly important, but I'm just showing you how I've evolved as a trader, or telling you rather. And I don't necessarily need a chart. I could trade literally sitting in my living room watching CMB's ticker tape. I don't need every minute by minute interval. I could literally watch that tape and trade. In fact, I used to do that with bonds. I'd have my levels on paper in front of me. I would look at the clock and say, okay, I'm expecting this. And as those levels would be touched, I know it's reaching for the next one. And if I saw that level hit, I would wait for the next update to see it downtick. If it downticked from that price level, then I could be a buyer there because I'm buying in downtick. It has to trade down for me to buy. I don't need a chart. I don't need it. Just like a floor trader did not need a chart. They did their analysis at night, and they carried their levels on their notepad in their hands, a little spiral, mead, their little cheapy little notepads they could put in their back pocket. Many times that's what most of them were using. And some of them were not even that well refined. Some it would be just a matchbook cover. Just a little. That's what they're looking for. They're holding that in their hand. Okay, or they tape it to the back of their hand. That's the levels they're looking at, and they're holding their tickets and they're buying and selling and doing their whole streaming business. They're not looking at fair value gaps. They're looking at actual hardline levels. So keep that in mind when you're watching this, because you're putting way much more emphasis on drawing heavy amounts of lines on your charts right now when you want to try to keep the goal in mind that you're going to have a very clean chart in the end and then work off of real numbers. So that way you're not looking at the chart because you have no idea how much influence having these levels drawn on your chart is going to have over your analysis. You'll be fearful. Oh, it's going back to that level. Subconsciously, you're thinking, okay, the last time it went to that level, it did this or didn't do that. And that's going to be a distraction versus watching what price is doing real time on these 1 and 5 minute charts. So you want to try to keep your focus on what's the main thing. The main thing is where's liquidity, where's inefficiencies. You want to have those levels from the higher time frame down. Now, I'm not doing monthly. It's not necessary here. But on weekly, what I just described here, that's my weekly key levels for going into this week. That's it. They may evolve once we see Monday and CPI. But for now, these are the only things I have right now for the weekly chart. It's pretty simple. And I did more jawboning about other things supporting why these are important. But what you're supposed to do with it over time, that's what I just communicated. I work off of a notepad and just simply writing down the raw numbers more so than having lines on my chart. But the data and derived expectations and how I'm reading price, I'm teaching you that by having the lines on the chart. Over time, those training wheels, like on a bicycle when you first learn how to ride a bike, you'll take them off and you'll just read the chart naked. And that's where your graduation is, where you can see it, execute on it with nothing on the chart and no influence or commentary by me. Then you don't ever need to come to ICT videos or watch live streams that I'm doing. That's how you know you're now independently minded and you can do this on your own and feel confident in doing it. And that's a good feeling. You should be striving for that. That's the goal I have for you. You need to adopt that as well. So let's go down to the daily chart real quick. All right, so here is the daily, and we have
the volume balance it to 2
here, and we have a volume balance in here. So I mentioned, I don't remember where I mentioned it, but because there's 2 of them here, you want to have all 4 of those levels annotated on your chart. So this closing price, this opening price, and then have the same color scheme for both of them, and then a different one for this closing price and this opening price. Why? Because they're 2 different respective volume balances. One is during the up delivery. For buy side, notice the candles are up and the next candle's up. This one here is a down close candle and the next candle's down close. So you want to make a distinction between that and how price, if at all, returns to either one of them. So you want to use like a very large number 4 level width on your charts for annotation. And like say this might be, I don't know, it could be green because it's green candles, and it could be heavy black number 4 thickness because of these being down close. And that'll help you understand which one it's referring to. Now you might look at it and say, well, what's the big deal? They're almost the same. It's a big deal because they're going to respect very specific levels if they come back to it. And if they do trade them this week, once it does that, I'll come back and show you what I want you to take away from it. But not having them on the chart, you won't have the benefit of knowing whatever may be a follow-up discussion. They might not even be a factor this week. They may not even go there. You don't know that right now. We haven't even opened a new week yet. But I like those 2 volume balances. I have those levels in mind on my notes. And we have consequent encroachment of this wick here. So be mindful of that. Consequent encroachment on this candle. Keep that going forward. You want the mean threshold of this down close candle, which is the midpoint. So you put your Fibonacci on the low to the high. Whatever the midpoint level is, carry that all the way through this week. You want to also note the opening price on this candle here, which is 4077.00, because that's an order block. we've dug into the body of that candle here. So the most important point from now on is if we're bullish, we shouldn't see it go below the mean threshold, which is half of that. But if we open higher, come back down and stop at consequent encroachment or fail to go that lower, then we're going to go back up inside this gap here. So that's how we would use the information for an example. And I think that's going to be it for the daily chart. So weekly and daily, those are your key levels. It's not a lot, but those levels you want to have annotated. Record them also, what they are. Don't just have the levels there. Write down in the description, like inside the trend line. Okay, there's a way of annotating with the text feature on TradingView. Annotate what those levels are, meaning the opening price on January 30th daily candle. Just in a very, very small font. Make sure your levels annotated like that. And in the consequent encouragement, the mean threshold of the order block, the same thing, you would have that annotated as January 30th mean threshold daily bullish order block. And you can abbreviate that the way whatever way you want to have in your chart that is meaningful to you. Which is why I'm not annotating the chart like this, because you're all going to try to mimic me. And that's not what I want to see. Not because I'm trying to hold anything back. I'm not being lazy about it. I'm teaching you how to do this on your own. So that way it brings your own personal flair to it, okay? All right, so let's go down into a 60-minute chart, an hourly.
That whole model was
okay.
off of a
on the range, what my eye is doing is I'm looking at this low, all the way up to this high, and I'm looking for a midpoint without even having a Fibonacci there. Okay, just looking for midpoint, and then we are trading right here, essentially at what? Equilibrium. Hourly. Chart like this, because you're all going to try to mimic me, and that's not what I want to see. Not because I'm trying to hold anything back. I'm not being lazy about it. I'm teaching you how to do this on your own. So that way it brings your own personal flair to it. Okay. All right, so let's go down into a 60-minute chart, an hourly.
We had consolidation, Thursday reversal, or Tuesday high of week.
Okay.
Classic.
On the range, what my eye is doing is I'm looking at this low, all the way up to this high, and I'm looking for a midpoint without even having a Fibonacci there. Okay, just looking for midpoint, and then we are trading right here, essentially at what? Equilibrium. So we are opening up while the market itself traded the inside of this large range. Why did I pick this high and this low? Why am I not talking about this high and that low? Right? That's exactly what some of you are thinking. He's in my head. Where was the most dynamic price movement? It's this move here, from here to here. So that dealing range is parent. Everything else, these little, the range, what my eye is doing is I'm looking at this low, all the way up to this high, and I'm looking for a midpoint without even having a Fibonacci there. Okay, just looking for midpoint, and then we are trading right here, essentially at what? Equilibrium. So we are opening up while the market itself traded the inside of this large range. Why did I pick this high and this low? Why am I not talking about this high and that low? Right? That's exactly what some of you are thinking. He's in my head. Where was the most dynamic price movement? It's this move here, from here to here. So that dealing range is parent. Everything else, these little minor movements and small little retracements and dealing ranges, they're subordinate to all of the movement from this low up to this high. It's going to be subordinate to what? The relationship to premium to discount from this high to that low. So if you split that in half on this eyeballing it, all of this here and higher is premium. So we're at equilibrium. So what I'm looking at is how much time have we spent in discount or premium, which has been done more. Clearly, we've spent a whole lot more time in what? A premium, inside the range between this high and that low. What has been explored? We went down into a discount a little bit, but look how fast we came back to equilibrium. I don't want to read too much into that because it's Friday. That's what we're seeing Friday's price action there. And we don't know how we're going to open up. But let's just say we open lower. Okay, say we open lower and we want to come back into the closing price or any one of these daily candles. I'm sorry, these hourly candles can act as the point of which it doesn't need to go back to the closing price on Friday. If we're weak, if we're looking for lower prices and higher dollar, a lower opening could see us come right back up, not completely return back to the closing price. Why? Why would I say that? Because we are essentially closing at equilibrium, and we've had multiple times here, moving back and forth. We don't necessarily need a very clean return right back to Friday's close if we gap lower. What it's likely to do is, if I'm correct, and I don't know this, I'm just giving you my thought process. You're wanting to be trained by me. You want to see what I do and how I do it. This is exactly what I'm doing. I'm doing it right now, real time, for the first time looking at the charts. I'm telling you what I think and what I'm seeing. If we gap lower and we trade higher, I don't need it to return all the way back up to Friday's close. Whereas if
we gapped higher. Oh, that's dirty. Look at the constant encroachment lines up with the new day opening gap constant encroachment. Or equilibrium marks up with the constant encroachment and new day opening gap.
If it were a move where, for instance, we ended the day on Friday like here, and we got down on Sunday's opening somewhere down here, I would expect a full return back to Friday's close. Why? Because it's really extended. And here we've had back and forth, choppy. But more specifically, it's coming right back to the midpoint of the parent price swing of this high and that low. All of that range, that big explosive movement, it's been resisting going higher. It just keeps coming back, spend some time. One more time, real excitement. Oh, there's a speaker. And then that fizzled out. Oh, we're going to really do it now. It's going to run higher. And then it fizzles out. We've taken out relative equal lows here, so sell side's been taken. The argument for the bulls would be, okay, we've taken sell side out. We should see a gap higher, trade down, try to fill the gap all the way to the close here. Now, see what I just did there? If we gap lower, it doesn't need to come all the way back up to the closing price on Friday because we've had multiple times back and forth in here. And the gap between Friday's close and where we open on Sunday, if it's like 77, 84 in that area, I wouldn't need to see a complete return back to Friday's close. I wouldn't need to see that at all. Because it's indicating what? Heaviness. And it's going to want to do what? Reach into this low, attack the low here, and then you want to have that fair value gap muted, and then the sell side liquidity resting below here. So that's the levels that I'm interested on the downside as discount. But devil's advocate, if it gaps higher, I would expect a full return back down into the closing price. Why? All of this inefficiency, we're gapping up into it. We don't know that. I don't know that, but I'm assuming, let's just, for the sake of argument, say we gap higher. And this is obviously a great deal of exaggeration where I'm pointing to. But conceptually, I'm trying to communicate the idea that a gap opening below Friday's close in this instance is not equal to the same expectation I would have if a gap higher formed. Because we've already spent a great deal of time up here above the midpoint of the low to high. So you have to think about the market in terms of overbought and oversold without the basis of having an indicator at all in your chart. How many times did we try to rally here and not go higher? 1, 2, 3, 4, 5, 6 times. And then finally, on Thursday, it gave up the ghost and traded lower. Now, we don't know if they've taken the market down here to accumulate the sell stops to send it and reprice it higher. The clue will be how we open on Sunday. Later on today, how we open is going to be influential for determining whether or not this is going to be resuming higher, or if it got lower, I don't need it to return all the way back to the Friday close. And I'm expecting heavy weakness right from Dome Street. And then this low and this low will be Monday and into Tuesday CPI number. That would be my objective based on this. Also note that we've had this high since we traded lower here. We went above it here, choppy, pressed above it here on this high relative to that high, pull back one more time, dug into it. It just feels like they had to come off of that discount because this was really, really low, and they did not take out that low here, and it didn't even come down to consequent encroachment of that wick, which would be also noted on your hourly chart. So because we've come all the way back up into essentially equilibrium relative to the high here and here, I would favor a down gap, an opening lower gap later today. And I wouldn't require or demand the market comes all the way back up to it before it goes lower. I wouldn't need that because we've already had multiple attempts to get back to equilibrium and taken out this buy side liquidity that will be resting below that high. Flipping the script, if we gap higher, because we've had a run below sell side here with this drop, and that we've climbed all the way back above, I would view that as a breaker. And the closing price, that would be all that's necessary, because then I would interpret it as, okay, they opened it here, traded back down into the range, which is the breaker, which is this candle over here, that up close candle. Extending that candle forward, that should be on your hourly chart. If we gap higher, it can come down and retouch the Friday close, and then I would expect to see it try to reach up into all of this inefficiency. If we gap higher, show responsiveness at Friday's close, and move higher, that would indicate that I'm probably wrong about my expectations on the market, and they might send this thing higher on the CPI on Tuesday. Now, stop for a second. What I just gave you is not plan A, plan B, because I'm telling you, I don't know which one's going to pan out. I have to wait, and I have to see what the market does on Sunday's opening. And then I weigh it out based on the things I just explained to you. That's forecasting. That's your own, that's my analysis, but that's your own way of internalizing what you expect to see price perform and deliver. It's not equating to a trade entry. All of that is going to be at a later time. These are things that I'm looking for to justify what? Bias. I don't have a bias right now. I never have a bias before Sunday's opening. I don't ever have it. I have a inclination. I have a want to see in price, but my will cannot be exerted on the marketplace and see it come to fruition. I have to align myself with what the market's going to do. And what I just outlined was the two circumstances that I would like to see. Either if I'm going to look to go short, I want to see these types of things form in price. If I want to go long and fade, what I'd rather see in price coming into this week, because I would like to see dollar go higher and everything gets smashed lower. I'm expecting that. I'm completely comfortable with being wrong. I've already co-signed it, and I've said it before. You've watched me now 2 times call CPI what I think CPI was going to do, and I was dead wrong. But after CPI hits the market, I'm going in, I'm finding winning trades and executing on them. So don't weigh so much on the outcome of a forecast. Forecasting is not profitable. You don't lose any money either in that. A forecast is an opinion, and I'm trying to share my opinions with you before we see the week begin. It's not a measuring stick. It's not a report card. ICT was right or wrong. I don't think of it that way. It gives me a plan of action. If it does this, I'm looking to do that. If it does this, I'm looking to do that. Whereas 90% of retail traders are just going to chase whatever happens. I'm not doing that. I'm thinking about it logically that we've spent more time trying to go higher all last week and finally giving up the ghost, but I'm being mindful that we've come down below these relative equal lows where sell stops were resting. And we failed to take this low out or even go into consequent encouragement. Now think about what I mentioned earlier about those little short stubby wicks. Sometimes it can trade down to those short stubby, even though this isn't a short stubby wick, but this is almost essentially what I'm referring to, where this dropped down, then it retraces. Watching price at real time, you probably were having this level if you're aware of what I've been teaching, the consequent encouragement on candles wicks. You may have been expecting that low to be reached, or maybe even go completely below this low here. But it stifled that decline and started rallying up into the range. What range? This high to that low. Now I'm not thinking, look at this high, look at this low, split it in half, there's equilibrium, and then wait for it to get to equilibrium, and that would be a good sell. I'm not thinking that right now. I'm thinking if we gap higher, trade back down, it's going to want to go higher above here, this high to that low. Now I'm not thinking, look at this high, look at this low, split it in half, there's equilibrium, and then wait for it to get to equilibrium, and that would be a good sell. I'm not thinking that right now. I'm thinking if we gap higher, trade back down, it's going to want to go higher above here. That's what I would expect, because then it would be just simply coming below these lows here to absorb that sell side as counterparty, and then they're looking to reprice it higher. So that's what I'm talking about by saying you need to be sitting down with someone and explain why they're thinking the way they're thinking. If you're just following someone that's giving you signals, they may be profitable, but they're not really helping you understand how to trade. They're just spoon feeding you. And there's an audience for that. Now, I'm not saying that if that's what you are and you don't want to learn this, it's too difficult, and you subscribe to that view, and there's people that are doing it and they're profitable, they're giving you signals. There's nothing wrong with that. In that instance, there's absolutely nothing wrong. But if you're trying to learn how to do this independently, the worst thing you can do is subscribe to someone and get signals when they're not explaining why they're doing it. Because in my opinion, it would create a sense of anxiety, because then now I'm dependent on this person. What happens if they get the case of the ass and say, I'm not going to do this today? Or they get in an argument with their spouse. They have a bad day. You're bringing your financial decisions to this person who's never disclosed why they're doing the trades anyway. That takes a great deal of faith, more so in my opinion, than simply putting the work into saying why you're taking the trade in your own analysis. But that's my personal opinion. It may not be in agreement with all of you or even the large part of you, but that's just how I think about it. So it's, in my mind, more likely, and it would be more favorable for me to see a lower gap, not come all the way back up to the closing price on Friday, show it as weakness, as a breakaway gap. That's why I would like to see that, because then it would indicate to me that it's breaking away from this retracement, which was only taking us back up into equilibrium relative to this low, the high, back into this old order flow. All these old lows in here, it pulled back up into that. Look how sloppily it was doing it. It was going up and then come down, up and then come down, up. It just feels like it's just reaching. One more time, one more time, one more time. And it's like that rock climber. He's just trying to swing, get that last bit of a grip, but there's not enough chalk on his hand. It's sweaty, and he slips off. And that's what I'm expecting. That's what I see here. I'm absolutely likely to be wrong, and I'm okay with it because it's Sunday. I don't know what Sunday's going to do. But that's my thought process going into it. Okay, so hopefully you can appreciate that. Don't bet the farm on it. Okay, because if I had a strong inclination about what it was going to do, I would be putting my own money behind it, and I'm not. So it's just an expectation on the marketplace I'm holding. All right, you can see again 1, 2, 3. Retail's going to see this as a bull flag here, and then want to go higher. Now, if we do gap higher, that changes everything. I'm just giving you all the reasons why that does change it. But here, bulls that went long in this or wanting to go long, they're going to want to see a gap higher. A gap and go type of event. I would like to see a gap higher if I'm bullish. Gap higher, come back into it, return all the way to Friday's close, and then show me willingness to want to rally. That's how I would wait and see. I'm not trying to just simply go in there and blindly buy the retracement back to the closing price. I want to see, does it give me a shift in market structure after that return to Friday's close? Flip the script. Gapping lower, I do not need it to trade back to Friday's close, because we have all this in here. Gapping lower, it can make an attempt to trade higher, leave the gap open partially. It doesn't have to come all the way back to or even halfway. It's better if it doesn't. What would that communicate to me? It's exceedingly weak. It can't even fill the gap. You see, that's what you're trying to do. Whether you know that is what you're expecting going forward every weekend before Sunday, you want to read price write down what you would expect to see relative to the Sunday's gap opening. Not because you're trying to train yourself with the belief that you're going to know how to do that, because I don't, and I've been doing it for 30 years. I don't believe anybody can tell you where it's going to gap open. If they did, they're way better than me, and they know something that none of us would know. Nobody has that information. So, but you want to be conducting yourself as a means of case study and walk forward testing and building confidence and trusting the fact that you don't need to know this piece of information, but how you're going to respond to that as an analyst. If it gaps lower, what do you reasonably expect to see it do? And what don't you want to see it do? What is not likely to occur? Well, here's an example of something I would not like to see, and I don't think it's likely to occur. A gap lower and rate from the opening lower go raging higher. I could be wrong, but the likelihood of that happening is less likely than a gap lower coming up, leaving the gap open, not completely closing it in, and then working lower to take that sell side and maybe dig into that hourly consequent encroachment wick and that wick's low, and that subsequent fair value gap to the left on the hourly chart before we went down to the 15-minute time frame. All right, so we've had 1, 2, 3 times as a 3 drives potentially pattern, and that's why I would also like the fact that if we gap lower, I would put more emphasis on this, reaching just simply get into the liquidity resting above here. Why was it doing this? Higher, higher, higher. Because the liquidity that was trailed behind this low, this high, as the market went lower, it was taking that liquidity, starting to break down. What happens then? Any stock that was higher than this was brought back down to what? This high again. They come right back above, skip this high, right back above this high again with this run. Then they start dropping it again. Okay, now I finally did it. Now we can get short. Now we can get short. Where's the stop loss at? Right back to an old high. You might be thinking here and here, but my focus and my eyes going right there. And they take it once more time, up above it again. It just so happens they're taking out each individual high too, which is killing 2 birds with 1 stone. That's how I'm internalizing that price action. It's too compressed, meaning that from the low here up to this high, all of these fluctuations back and forth, even though they made higher highs and I guess higher lows, I'm not convinced that that's something that's bullish. Like I see that as just constantly reaching for liquidity that would be in the form of buy side, keeping anybody from potentially profiting from a lower gap opening and never coming back up to those levels again to give them a safe. And they take it once more time, up above it again. It just so happens they're taking out each individual high too, which is killing 2 birds with 1 stone. That's how I'm internalizing that price action. It's too compressed, meaning that from the low here up to this high, all of these fluctuations back and forth, even though they made higher highs and I guess higher lows, I'm not convinced that that's something that's bullish. Like I see that as just constantly reaching for liquidity that would be in the form of buy side, keeping anybody from potentially profiting from a lower gap opening and never coming back up to those levels again to give them a safe entry, which is what they would want to see. More specifically, not coming back to this old high. So hopefully that kind of justifies what my internalization of price action, what I am forecasting from my own observations. If it does anything other than those potential scenarios, I'm sitting on my hands and doing nothing. Wow. I just gave you the upside if I'm wrong, what I would look for. I gave you the downside, which is what I'm looking for. The things that I just outlined, if the price doesn't deliver those very things, I'm doing nothing, and I'm not going to be anxious about doing nothing. I'm going to be completely content sitting still because I'm going to be requiring more information to happen on Monday at 9:30's opening. Why? Because there's no news event that's going to be of interest to me on Monday. Why? Because Tuesday is the CPI number. And it's going to be the big event. A lot of people are just sitting on their hands. There isn't going to be a lot of movement until CPI hits the market. No one wants to assume positions ahead of that number, that report that comes out on Tuesday. So there is not any reason to be excited about doing big moves in Monday.
Oh, it's good.
Because the big move is absolutely predictable on Tuesday. The CPI is bringing it. Hopefully that makes sense, okay? And I think that's going to be it because we've already went down the lower time frame stuff talking about it real time on Friday. So hopefully you gleaned something from this, and I'm sure you probably got a million other new questions because of it. But until we get the opening price on Sunday, well, tonight I'm talking like we're in a different day. Once we get the opening on Sunday, and most of you won't be caring about it because you're going to be drunk and watching, grown men run around, with spandex on chasing a football. So enjoy that. I don't even know who's playing in it. That's how much I care about football or sports. But I hope your team wins, whichever that one is. And if you're out and about, make sure you get home safely. And I'll touch base with you by way of Twitter, I'm certain, to let you know when I'm going to start my live stream in the morning. Okay? And I'll talk to you next time. Be safe.
I wish he was. Imagine if he was doing a 2024 mentorship. That would be crazy. So we see here, we gapped lower, and we ran away from it. We left some of it open. We come back down to this gap. We use it again. Let's play slower. Alright, I do want to look at this price action before I watch the tape reading session, but we have SMT at these lows. in the current new week opening gap, and then this looks like it's a breaker. We manipulate below 830. Excuse me, sorry, but not true day. And then there's a 2022 model here. What's this? Oh, red line's at equilibrium of that dealing range. And then where do we close? At 4. Right above that new week opening gap. What does lunch hour do? Lunch hour kind of just consolidates. Then at 1:30 opens, we get initial swing higher, swing lower, and then another swing higher. I'm gonna type out some of these notes.
5-minute chart on the left-hand side. All right, so we have a 5-minute chart on the left-hand side. That's the US 500 for folks that are tracking the CFD that can't trade with the, well, not trade, but tape read the E-mini S&P 500, which is the futures contract chart on the right-hand side. So I'm trying something new today. I'm going to be very cautious because I'm trying to get comfortable with both charts up here. So usually this would be a very big distraction for me. So I'm going to try to do my best to focus on the ES so you guys can see the difference, as close as you can real time, because I know there's this very small delay between what I'm saying and what you receive on your device through YouTube's broadcasting. All right, so I don't have any annotations on the US 500 CFD chart. You're going to have to track that respectively as we look at and compare both. I know that might not be satisfying for some of you, but I apologize if I'm not going to be able to do all the plate spinning that some of you want me to do. And if you look at the ES chart on the right hand side, again, this is a 5-minute chart. We'll drop down to one in respective lower time frame if there's a necessity for it, but right now there isn't. The opening price Sunday for ES came in at 4105.00, and the closing price on Friday came in at 4099.50. The difference, it's a gap higher. So this is a new gap opening gap rather. And the midpoint between those two price points is this heavy dashed red line. You can see we came down to that beautifully so far this morning, showing a willingness to want to respect that level. So everything so far is delivered as I teach it. I'm watching this volume imbalance in here, and I'm also watching the buy side liquidity resting above the high here on ES. Now, apart from the new opening gap levels on the chart and a few things I've added from the daily, I'm going to try to keep the chart clean as I can. I'll be mindful that where ES is trading right now, it's higher than Friday's close. So there's a premium in respect to the opening price versus where we closed on Friday. So what I mean by that is this. See that gap? So we're gapping up here when it closed down here. So it's usually going to create some kind of a draw down into the price action. The levels I like first is the high on Friday's session. Then all the wicks in here, study that. There really isn't any inefficiency in here on the 5-minute chart. So we drop down to a 1-minute chart. I know you want me to be busy with that US 500 chart to the left, but we're really early in the session and there's nothing here that I want to participate in yet, or would want to participate in. So here's that gap, and we want to see it likely try to drop into that. Doesn't mean it will, but that's the first expectation when we look at the opening. So we're watching the opening range. As a reminder, tomorrow's CPI, so my expectations today are rather low. But I'll try to work out a range, and you can observe it real time. Maybe get a 5-handle run. You can study that live before the close of this morning session. Now that 4111 or 4111 line that you're seeing here on the right-hand side chart, what that is the constant encroachment of the daily candle from February 7th, 2023. The wick, the lower wick on the bottom candle, that level is what's being what that is the constant encroachment of the daily candle from February 7th, 2023. The wick, the lower wick on the bottom candle, that level is what's being annotated right there. And just above that, should we get some kind of a, see now I like this right here, this looks like it's failing. And reach down here to the lower end of the gap. Do not take any of this as trade advice, please. All you're doing is tape reading. You're observing, trying to get a feel for what the market's likely to do. There's liquidity resting at the 4102.25 level. That's in the form of sell side. We have relative equal lows here, here, and here. Now I'll drop down on the 1-minute chart on the US 500 chart on the left-hand side. So if you look at the high here it formed down to the midpoint of the new opening gap, that is consequent encroachment. So what I'd like to look for is a price run that moves higher, that can be faded, or I expect to see it fail, or maybe create a sell signal, something to that effect. And if we can get through, and there's nothing saying it's going to do it yet, but if it gets below the consequent encroachment level of 4102.25, if it breaks through that, that becomes, in my mind, a fulcrum point. And then if it trades down to the low end of the new opening gap, which was Friday's closing price, if you can trade through that, we would look for the first objective on the downside would be 4098.50, and any further animation to the downside would be 4094.75. And frankly, that would be as far as I would expect the morning session to move. Simply because, not to say it couldn't move, and not to say it's going to go down there either, because it could go run up there and take out 4110. I have nothing in here that I like. All you're doing is observing. With the expectation the CPI is going to be the big monster move for the week. That's the reason why caution's advised here today, and not try to get all of what you were hoping to make for the week all inside this one day. Okay, we trade back to consequent correction.
Yo, what's good? Ab?
Does it want to drive underneath that aggressively and expand down into 4099.50? 50-year-old bones cracking. On the US 500 chart, I apologize. Like I said, this is an opportunity for me to try to grow a little bit more as a mentor here, trying to show both vehicles. The 4087.6 level and 4083.9 level, that would be my expectations. It should be break below and get animated below the low here, 4091.2 on the US 500. This is what that chart is over here on the left-hand side. You're hearing our recycling truck come through. I pick up our recycling, so apologize if it's coming through in the audio. Okay, return back into the high end of the new week opening gap. So far, nothing really stands out with the relationship between the NASDAQ and the ES at the lows of the day so far, after 9:30's opening. So no SMT divergence there. So I don't see any reason for it to draw our attention to the NQ. And since I'm primarily showing one instrument throughout this year, I'm teaching you to be a specialist, number one, so that way you're not jumping around, because all the price action you ever need can be found in one asset. Okay, nice run away from that 4102.25 level. All of this is the opening range. So the first 15 to 30 minutes, there shouldn't be a whole lot of emphasis placed on any of that. When we get into the 10 o'clock hour, usually there's algorithms that start running in that time frame, usually 950 to 1010, and we'll look at what buy side or sell side liquidity and any inefficiencies that reside. Okay, nice run away from that 4102.25 level. All of this is the opening range. So the first 15 to 30 minutes, there shouldn't be a whole lot of emphasis placed on any of that. When we get into the 10 o'clock hour, usually there's algorithms that start running in that time frame, usually 950 to 1010, and we'll look at what buy side or sell side liquidity and any inefficiencies that reside at that time. Right now, all we're doing is trying to get a feel for what it wants to do. It's too early to tell, really. It's high probability. I know some of you gamblers out there already have a clue what you want to see it do. It doesn't mean it's going to do it. So we had a run pre-market for 9:30. We made an attempt to get down to Friday's close after opening at 9:30. Found some support at the consequent correction with the new week opening gap. Buy side now is in the crosshairs. And that would look like this value over here for US 500. Now, what I'm interested in seeing is how we trade. Should we take out the high at 727 candle? So if it runs through that buy side, how do we deliver after that? On your, on your 15-minute time frame, the February 9th, 2023, 12:30 or 12:30 candle, there is a sell sign bounce buy side efficiency. You want to extend that to the right. If we run through with a lot of momentum on the upside through 4116, we could see 4122 and a half. Just be mindful that's what we could see. But if we get above that 41.15, reject that and start to break down, then I would look for it to try to return back to Friday's closing price. Because all of this right here could be just a Judas swing for the morning. What makes me extremely cautious and not having strong convictions on where I think it's going to go is because we have CPI tomorrow. And I'm kind of in my notes in front of me, in my pad right here. Real bold letters, CPI tomorrow. Don't get pip jump. So don't fall in love with something you think is going to be an explosive, huge move. Just look for your bread and butter setups and be content with it. And tomorrow, wait for the carnage to come. So far, Nasdaq's basically on par with the highs as well. So nothing's really standing out as an obvious run here. Still 50-50. And when you're new, when you're just ready to do something, you feel like you want to just push the button and see what happens. But you know what they say, when you have a round, you find out. You don't want to find out, and you're on the wrong side of a market move on a day that's already not likely to do very much for precision. That's my view on it. Now, I would like to see it rip higher, only because we came back down into this breaker here. This is this up close candle. We came into it and also traded inside and completely repriced to the low of this buy side, bounce side efficiency. So 41.18. That'd be a nice reach above for that buy side. But anything just piercing through this is enough. Now, US 500, if you notice that, it's already done it on the left-hand side, but futures have yet to do it. And what you're doing while watching price with me like this is you want to train your eye to, number one, look for runs that make sense to you. What pattern from the content that I teach, which one do you trust more? Or which one are you able to see as clearly as possible watching a small time frame like this? But don't think that it only works on these lower time frames, because everything I'm showing you with these candles on a 1 minute basis is absolutely the same thing if you were looking at an hourly chart or a 4 hour chart or a daily chart. It just requires a lot more time for that candle to complete and close and start a new one. And obviously the ranges would be much larger, which for some of you is probably what you're looking for. You want big runs, you want high R multiples. You can use the lower time frame entries and trade with the higher time frame PD rates and get these extrapolated returns versus the small, minute theoretical risk. It looks like it's just crouching right below that buy side liquidity pool at 41.15. Like I said, US 500 on the left hand side. That's what that chart is. It has already whipped through it and tapped into its buy side. ES on the right hand side has yet to do it. So since we had this run here, I'll kind of put it on the chart so you can see, as much as I don't want to do it because it's a distraction to me. That is your bullish breaker that traded down into a buy side and balance sell side efficiency. So buy side's about to get ripped through. So from here to here, it's a 5 handle run. You would want to see it expand a little bit more than what it's already done here through 41.15. And when it does that, you want to, if it does, that could be wrong. But if it doesn't, you want to screenshot your chart there and have this as a framework, because we were looking for the trade down. I mentioned the breaker, buy side and balance sell side efficiency. I want to see speed and distance here. It should rip through that now. Watch this wick right here. I'm watching the midpoint of that. It's constant encroachment. We've already tapped it here, so I want to see it expand through. Anyway, like that. Let's see it from 41.18. Now the same thing I did with the downside objectives. We're using the fib for like targeting. What you're looking for is price runs that have retracements and a buy side liquidity above where the market price is, and you're looking for bullish runs higher. How far can you go? That's one of the things that I was trying to teach last week. You see this high here? We're using it with that low, and if we went below this low here, yes, we whipped through it, but did it really trade through it and show limits a bit lower? No, don't just tap through it for the sell side. If it's a fulcrum point, it's going to run right through it. Like this high here now becomes a fulcrum point from this low. So from that low up to that high there, you can see why I was looking for 41.18. And it's just simply me looking at it for years, seeing that range, and I'm multiplying it between that low to that high. What's a one standard deviation of the same range higher from this high here? If this high is broken to the upside and come back down into a bullish breaker, what makes this a bullish breaker is up close here. We have a low, a high, and lower. Why am I not using the wicks? Because they're gaps. I'm taking right back into the price action. That is what? Showing the bodies. The bodies tell you the story. The wicks is where the damage is done. So I'm cutting through candles to take you to the narrative of what should be expected in price action. Even in a sloppy morning like it is here, we'll talk to you. I don't have the 41.18 delivered yet. It may not do so. And it would not be a terrible, upsetting thing for me because, like I mentioned when we first started the stream, my expectations are very, very low because of the volatility that's expected tomorrow. There's a lot of traders that are sitting on their hands saying, look at this, taking today off, and not worrying about today. because they know there's going to be a lot of movement tomorrow. There's going to be a lot of displacement in price, and it's going to create all kinds of sentiments. Big runs higher, big runs lower, inefficiencies, fair value gaps, liquidity pools above and below the marketplace. There's going to be a lot of interest in, and that's what you want to. You want to wait for that displacement. It's like when you walk up to a smooth pond, and it's smooth. You want to wait for that rock to be thrown in there, and it creates ripples. There's action. There's something to keep your eye on and watch. There's movement. Right now, we're just seeing just a little bit of movement. It's nothing really terribly exciting right now. But should this high be taken out, like it does here, notice the difference how this one runs through, closes through, and really rips higher, then comes back down into what? This buy side imbalance, so it's inefficient. This shaded it. I'm going to change this color so you can see that contrast. Not that I want it red, but we'll do that. Here comes that 4118 level. So we traded down into that. So there's two PB arrays in the form of a discount. Because price is here, it trades down into this up close candle here, which is the highest up close candle between the low here and the lower low here. So we traded through it, and our attention goes right into that candle. And we have the buy side imbalance, so inefficiency. So trading into that here sets the stage for a price run. This becomes a fulcrum point. We can use the wicks for those types of things, but not for breakers. We don't use it for that. And since the buy side liquidity is 41.15 even, that's what we annotated, can we use this objective here? Sure, you can use that as a partial. Like if you took a long in here, or for your annotations, you annotate that as this offered a wonderful opportunity to get, and not even take the buy side that would be resting at 41.15. But you'd be looking for, in my opinion, the run to 41.18 simply because it's above the buy side liquidity, the high here. Let me show you. It's above this high here. So this level here would be okay for a partial. But in my opinion, if I were in this trade and I didn't have the uncertainty of what we're going to see today versus what we're going to get tomorrow, a lot of movement for CPI, by having the economic calendar in your windshield, you're looking ahead, preparing for what's available in terms of risk and where the volatility is coming. You have to keep your expectations low ahead of the day of CPI. It might create all kinds of wonderful opportunities, but for me, my risk is pared back a lot. My interest in taking a setup is going to be extremely more picky. Like I want to be more selective in what I want to trade on, because I'm already in an environment that's not likely to deliver as precise as I would normally expect it to, because there isn't a lot of participants coming in today, whereas tomorrow, after CPI comes in, there's going to be this big mad rush to get in there, chasing something. Now let's check. I'm looking at the NASDAQ at the highs. So far, I can confirm that run up in here. That looks like NASDAQ has supported that run. 100. I've noticed that they don't really respect them so much, or as precisely as in the futures market. So even if you can't trade the U.S. futures market contracts, like for ES or NQ, it's worth it for you if you are. I'll just do that. It's worth it for you to get the data to track these U.S. markets. Because if you're trading the CFDs like the U.S. 500, U.S. 100, and U.S. 30, you're going to get more trustworthy data if you're looking at the futures market. That Super Bowl last night. That's actually the first Super Bowl game I sat and watched. Actually, it's the first football game I ever sat and watched. See if we can get that 41.18. Now we're above that volume balance. pardon. Do we get a touch of that volume balance again and then send it to 41.18? Watch that. Or does it rip right through 41.18 going to that 15-minute balance I mentioned? I would have liked to see that candle come down to stay volume balance. That would be nice to see that before taking out this high. And then rip into 41.18, 41.21 and a half. I wouldn't want to see it now. And why am I saying that? Because we've already started the run and we went above the bodies of these candles. So now I consider this series of two down close candles as a bulge or a block. Now let's see it support price around here. You can come back to this candle's high, but I'd like to see that stay open now. See that? You can see that right there, stay open. It can touch that open of that candle and then rip into 41.18, 41.21 and a half, and then on your 15-minute ES chart, you're going to have 41.33.75 noted as well. That's the high end of the 15-minute fair value gap, which is a city. I'll show you on the chart now. One's looking at it. There's a 41.18. It's the 15-minute candle at February 9th, 2023 at 12:30. The timing over there. So if you look at the 15-minute time frame. Right here. So if you're looking too close and you have your candles so drilled in, you won't be able to see this or appreciate the levels that it's going to likely reach into. So we're dropping that 15-minute fair value gap. And you want to get your level in the middle, which is constant encouragement. So 41.28 even. Have that annotated on your chart as well. And when I have something like this, you want to split it once more. And you'll have a gradient of 4 levels. So we're going to look at 4125.25 and 4128.25. If we were to get a blow off, move to the upside, this fair value gap on the high end here, 4133.75, that would be my morning session high objective. Should it reach that, I'd be content to move to the sidelines. I'm already failing as the US 500's not being annotated. If we know some of you would like me to do. It's very difficult for me to focus, I apologize, but at least you can see the difference in what the US futures contract is doing in respective highs and lows. I'll put 15 up on US 500. So you have 4118.6 for your consequent encouragement. That's fair value gap on US 500. So just make sure you have that number on your chart. Those are final on the CFD on the right hand side. So you can see how watching in the morning using the opening range, not rushing, not trying to get in there and make a decision right away. These types of price runs, they're not essential for you to be a part of, especially while you're learning. Can you guys give me a shout back at me on Twitter if everything's coming through audibly? My audio's okay, please. Okay, good. Thank you, appreciate that. Now let's go back to that fulcrum point I was showing you when we're looking for expansions. Because we're already through the buy side and we're inside of that old inefficiency on the 15-minute time frame from February 9th. So since we're in between the low and the consequent encouragement or midpoint of that 15-minute gap on the 9th, the 12:30 candle and the 15-minute candle respectively for that day, February 9th, and you have this level here, what you're going to do is drop your fib from the low up to the high of the wick, because we can use wicks for measurements of range and targeting. The only time I'm using a wick for entries is when I'm using consequent encouragement or the quarter point of that wick. Those are two most important levels for me on a candle's wick or a candle's tail, the part that goes below the candle. This is usually referred to as the tail, and the wick is usually the upper portion above the high. So we have a standard deviation of -2 here at 4126.25, then consequent encouragement. And then we have 4130.50, and then -3 standard deviations at 4134.5, which is outside the spectrum of the February 9th fair value gap. So I'm not really interested in that one because it's, in my opinion, a little overzealous for today. If we can hit consequent encouragement, that's satisfying for me for the morning session. Now looking at the run from 950 in here, so the market trades back into an order block, and 950 to 1010, that's a macro. It's likely to do what? We were looking for a price to reach into 4118, 4121.5, and then also into this 15-minute fair value gap. This price supported here, that's what I'm watching, at the low end of that 15-minute fair value gap. If it starts to run, as soon as it hits this level, should it do so? I don't know if it's going to. Should it do that, you want to screenshot your chart as soon as it does that. And log it and annotate what you've observed this morning. You're managing and developing patience when you're tape reading. There's no animation in my voice. I'm not terribly excited or shocked. I'm not risking anything. I don't care about being right or wrong. All I'm doing is pointing out where the market's likely to go. When it fails to do certain things, I'm making that observation with you, sharing what it should be doing, what it shouldn't do. And we're still, as much as this might look entertaining to some of you, this is still very, very ugly price action. Still can be traded, obviously, but it's ugly. And when charts get cleaner, watch this little inefficiency here. When price cleans up a little bit more, and it will, you'll see how fun and precise things are. It just becomes really, really easy to see the setup. You can't hide it. Not that they're really trying to hide it here. I don't want you to read too much into it when I say that. It's just hard to ferret out the really low risk, high probability setups in environments like this, because you get a lot of chop, retracements, a lot more movement against your position entries than you would like to see in like easier market conditions, which you'll understand later in the year. By contrast, days like this versus days when you see the outline move where it should move, where it shouldn't move, and it just takes off runs. Real nice and sharp, no real deep retracements, almost like immediately in the money. That's a low resistance liquidity signature. So that's really what I'm trying to teach you this year. But we have to work in every individual daily range to fully appreciate what it is that makes a low resistance liquidity run. When I first started teaching my older students, they were hard pressed to understand what I meant by that, because we were doing live sessions and I'm trying to communicate the signatures, what it looks like and what it doesn't look like. And when you have a group of people that come in, this will be spoon fed. Doing a signal to buy, doing a signal to sell. Where's my targets? Where's my stop at? Then that doesn't satisfy right away. When it doesn't satisfy a student or a viewer like that, they have a hardline opinion. Oh, it's a scam. It doesn't work. It was never promised as a signal service. It's to teach you how to read price action. And that's what I'm promoting here. So all I'm doing is helping you read the tape. If you can read price action, you're going to learn what your favorite setup is. By default, it's going to happen. So what I just did here was we had a retracement down into a fair value gap. What kind of fair value gap is this? Buy side imbalance, sell side inefficiency. Up close candles that create a fair value gap is a BISI, B-I-S-I, buy side imbalance, sell side inefficiency. We had sell side offered here on this candle. This candle's high comes in at 4120.50. This candle here Its low comes in at 4120.25, 1/4 of a point, one tick outside the fair value gap. That's permissible, that's reasonable, it's not upsetting anything. But that's also the signatures of a day like this, where I mentioned before, the precision is going to be slightly skewed because tomorrow is the real event. That's the real event, that's the thing everybody's waiting for. So it's going to be a little bit less perfect on a day like this. Much like the reasons why I try to justify why I don't trade on Thursday and Friday non-farm payroll. Because it's like this, where it can be just a little bit outside the lines that I like to see it color inside of. But what I'm showing you here is, should we run higher and take out the high? Look what they left. And that can be, so we have relatively equal highs here. To me, I view that as engineering liquidity. Don't be surprised if they take it below this low now, because that'll sell the idea that this is a top or a resistance level. And if you take it below this low here and retrace down into this fair value gap here, look at all the back and forth in here. See all that? That to me is a balanced price range. So meaning, as much as I'd like to see this stay open in that as a breakaway gap, if I was bullish, I have no position on it. But I'm making a case for arguing if I was already long down here, I'd want to see this left open, do all of the reaccumulation of new longs here, and send it above these highs. But I'm willing to accept the fact that because they've now priced in a relatively equal high, these two highs being basically the same, if they take the short-term low out here, then it can come back into here, which is, again, one of the reasons why I teach not to trail your stop loss out, because you don't know when these fair value gaps are going to form. They're too new. You have no idea when they're going to form. I usually have a pretty good idea where they're at, because I'm familiar with the range I'm trading in. And because of signatures like I taught last week and before, where using the PDA matrix when it's in a premium to discount, just like there's a threshold when you don't want to add new pyramid entries, there's also a threshold that you want to see price move beyond before you consider moving your stop loss up. And I'll cover that this year, don't worry, but we're not even in the entry points yet. Right now you're just trying to reprice, because if you don't know where it's going to go or where it's going to try to gravitate to, it doesn't matter what your entry strategy is going to be, it's going to be probably wrong. But if we can trade above these relative equal highs, we have a standard deviation of negative 0.5, which is just short of consequent encroachment this level here. So at 4127.50 and then 4129.75. So let's assume that it does find its way up to this level, midpoint of the 15-minute gap on February 9th. This would be my objective for the morning session, and I'd be content. If it goes through it and expands, we always have the probabilities of it reaching to the high end, but I don't believe that's something that we should look for this morning. I could be proven wrong. But if it goes through consequent encroachment, it could go to this level here. So what I'm always doing is I'm getting measurements, not doing classical fib ratios to get, like targets. Like you see anybody that teaches Fibonacci, they'll teach you fib ratios that supposedly the market's moving towards. These levels here are standard deviations, and you're going to find that they're going to serve you better over time when you understand the narrative of where price should go and with liquidity, and coupled with inefficiencies when they exist in price. In plain terms, these are going to be better for you than the classical retail ratios that Fibonacci levels are usually attributed to. Which is why you see people trolling over the years. You don't even use a Fibonacci rate. You're right, I don't use it like retail. I'm proud of it. So in your mind, you should see these relative equal highs here as a buy-side liquidity pool. Now we took out that short-term low. So anyone that's being short or going short, they now have their stop loss right above here. What kind of stop loss? Buy stops. Which is why I write buy-side liquidity. Still spelled written. My eyes are old. And it needs to be on the top, left. And it's large. Okay, so we want to keep this fair value gap annotated. Just extend it forward. And in here, why do you sometimes use lines and sometimes you use rectangles? When it's in close proximity to one like this, it helps me keep my fair line when I'm teaching you. So as I'm annotating charts, if I'm a trade example I'm showing you, I'm going to make sure that I'm not going to get confused as to what I'm looking at. Because if I have too many things on my chart, it takes away the purity of reading price. So like I said, it's very difficult for me to keep my focus and talk to you about what it is it should do and shouldn't do. But I mentioned if we take out that short-term low here, we can dip down inside this fair value gap. So far, we're seeing institutional overflow entry drill, which is a partial entry into a gap, which is a fair value gap here between this candle's high, this candle's low. What kind of gap specifically is this? A buy side imbalance, sell side inefficiency. Buy side was offered, it's inefficient in what? Sell side. But if it's bullish and you're going to run on retail that are, in my opinion, being introduced to a potential shorting opportunity for them, and they trust when they see these types of things here, that double top type thing. It looks like the textbook version of what? Resistance. And if they drop it down below a short-term low, what do they see that as? That's a market structure shift, or it's a break in market structure. And that may be true, it may happen here. But I like to look for periods where there's an arm wrestling match between these two categories of traders. Yes, this is reasonable to trade back down here. It didn't even go to the midpoint of this fair value gap, which would be consequent encroachment, because it's a gap, not a candle or order block. If it was an order block, it would be mean threshold, because it's being identified as an imbalance. We didn't even trade down to the midpoint of that. So let me show you what I mean by this. Between this candle's high and that candle's low, we have a price point level of 4118.75. So we didn't get down to that level here on this candle. This candle's low comes in at 4119 even. So it's 1/4 of a point higher than that of the midpoint of the gap, which is 4118.75. Because it didn't go down midpoint, this is viewed as institutional overflow entry drill. I know it's a mouthful, but it just means that if you're bullish, if you think prices are likely to go higher, I'm not suggesting that you should be long, but if you are expecting prices to move higher and you see a fair value gap, and you want to see a level of imbalance like this stay open, which would be the argument if you were bullish. Okay, if you're bullish, you want to see it try to reach up in the consequent encroachment, because we have time. Look at time still. In New York time, that's what your chart should always be on trading view. It's 10:16. So there's a little bit of time left still, and it can expand up into, to take the buy side out, up to it, through it, and maybe hit consequent encroachment. And that would be a wrap for the morning session, and I would consider this a profitable endeavor over charts. But because we only came down partially in here, the idea of leaving some of this open, and I don't recall now because I've I've been looking at this chart on the left-hand side and going back and forth and trying to keep my thoughts collected as I describe what it is I'm looking for. I don't recall, but I think I did, and you can correct me if I didn't. I believe I said I want to see this fair value gap left open before we see this traded through and maybe even hit the consequent encouragement. If I didn't say that, just know that I would have liked to have said that because that's what I would expect. But I think I did say something to that here. But again, you can go back and listen to the recording. So I mentioned this high legacy because of breakaway gaps. You know, I know I said it because I want to see that stay open. Breakaway gap is just like a signature where you can see price really snapping higher and having no real immediate interest to come back in to reprice over top of all of this. That's sometimes very indicative of seeing higher prices. But because we've met a 15-minute premium array in the form of that fair value gap, we dug into what? Did we meet the lower quarter of that? Just fell short of the quarter level of that fair value gap on the 15-minute time frame. We keep coming back into this fair value gap. The fact that it's doing what it's doing right here is also another reason why I'm teaching and preaching to you caution on a day prior to like news events like non-farm payroll, FOMC, and like tomorrow's CPI number. This type of price action is a classic delivery in price, where it's just a lot of hurry up, move something, move somewhere, and then chop around a little bit and drive you nuts. Because you just want to get out of the trade. You just want to get the trade to go to your target, be done, and be over with. Unfortunately, when you're trading ahead of high impact news drivers like CPI number tomorrow, non-farm payroll, FOMC, something to that effect, you'll get trading conditions like this, which makes it high resistance. So high resistance liquidity runs. We're looking for a run into the imbalance midpoint at 41.28 even. That's my objective for the moment. Should have hit that. I'm gonna do moves like Jagger for my wife, and she's gonna be like, whatever, you didn't take the trade. But for learning purposes, you'll see that this is what it's like to be delivering in high resistance liquidity run signatures, or conditions, not signatures, where it's really, really frustrating sometimes before it gets to your objectives. And another one would be how we failed just 1/4 of a point, one tick, before getting to the quarter level of that 15-minute fair value gap. On another day, it would have right on through 41.28 even, and probably even climbed all the way through to the high end of it, being this hit. Okay, but all of this right here is what you're going to endure if you force yourself to trade in conditions that are high resistance. High resistance doesn't mean like support resistance. It means it's resisting clean price runs where they just run big ranges, speed, efficient run right to where you want to go. That's how you want to trade. You want to trade in those conditions. But as a neophyte, someone new to trading, not really versed in price action, even if you are properly in trade for a long time, it's probably something you really never pay attention to. There are times when the market gives you these very stagnant types of conditions where, yeah, if you have a really wide stop from your entry, don't ever really move it, and just endure through the entire session or the entire day, your target may get hit. But because you're not sitting in front of the chart watching every individual minute candle, it will be very frustrating. And for a new student, what I do is I take them into the charts and show them, by contrast, this is a high resistance liquidity run condition. This is what we can expect and what you would endure, so that way they can feel what it feels like to be in that. Like, it's a lot of time. It's moving very, very lethargic in a small little range before taking out buy side liquidity. Whereas you would have rather wanted to see what? It trade down to that blue rectangle and then volley higher, ripping through the buy side and touch 41.28 and we swing our checkered flag and we're all happy. That is not an immediate gratification in conditions like this. You get that type of immediate gratification, immediate feedback that you're on side, the right side of the marketplace, in low resistance liquidity runs, where it doesn't do a lot of this consolidation. It's in a hurry to get somewhere. It's in a hurry to get there quickly. And if you're on the right side of the marketplace in those conditions, it's very satisfying. There's nothing more satisfying than that. See how it just went up there and just got real close to the buy side, and then we're pulling back down to the low end of the fair value gap. This is the stuff you want to record in your journal. You don't want to say, this is so damn frustrating. You don't want to do that. But you do want to observe the length of time that it takes, and maybe ultimately a failure. It doesn't mean it's going to go, I don't know for certain if it's going to go above that 41.25 and clean that buy side out right now. They could leave it just like that, retrace, and then later on in the lunch hour, or on the other side of the lunch hour, wipe through that buy side liquidity. That's the problem that you're going to encounter trading in these environments, versus when the market's really obviously loaded up to go in one direction or another. It's one-sided is how I teach it. If you can justify the trade only in one direction, that is my ICT definition of high probability. And that high probability condition is what we refer to as salad days, easy day trading, like easy, get in, get your money, go home. Whereas now, when you're in these types of environments, you're working for it. And at the end of these days, even when you're profitable, you feel like you've worked out. You feel like you're drained. You just want to take a nap, relax, and not even want to look at the chart because it's drained you. Because you're taking a lot of time and energy and you're burning a lot of calories. Your brain's doing a lot of calculations, what if thinking, you're anxious, you're running all kinds of scenarios. What if I don't take my partial here? What if I don't roll my stop up here? What if it comes against me and digs in, takes away 40% of my profit? How will I feel if I don't take my profit here? What happens if I do take my profit here? And it runs the buy side and goes all the way to the top of the fair value gap. That's what you're going to encounter, and you want to observe all that. That's the whole point of me sitting with you at the top of these charts, because that is how you learn. Because you're going to discover a lot of things about yourself that you probably thought you were very strong. Your will was strong. You're very disciplined. You think you're disciplined. You think that you know what you're doing. But when you're forced in front of charts like this, they are a mirror. They're going to show you who you really are. They're going to show you all your imperfections. As wonderful as they are, that make you unique, you have to refine many of them as a trader and keep them from manifesting themselves in your charts for your trades. And that's not easy to do. And I'm not guaranteeing that I'm going to be successful for everyone in that regard, because all of you have your own individual personalities. And there's character flaws that all of us have. They may be viewed as a cute little quirky thing that your spouse or significant other likes about you. But in the markets, they will serve you. You're a win. So you have to be mindful of that and understand that a weakness is not something that makes you a bad trader. It just means that you have something to improve upon. And you have to develop coping skills for some things, which my coping skill that I needed right away when I first learned how to trade was the fear of getting in. I needed to know that what I was using to get in the trade was worth even employing. I discovered also here. Sorry, I know some of you were mad at me. Can you just go over to one chart so you can see what's going on? You can see what the US 500 chart's doing when you're in if you follow along that. As long as you can see what the US futures market, the ES on the right hand side is doing comparatively, you should be fine. Did I do this? No, I don't think I did. Buy sensitive spent. No, this one. So we have 4118.64 US 500. See what ES is doing? See how it's sitting there crouching below? This is the type of stuff that's going to drive you nuts in these environments. You're going to, like the other day when I was in there and I was looking for 4101.50, that was one of the numbers was. I called the high tick, but the difference between the bid and ask, there, that's what we're looking for. See that? It feels like a, well, I'm not use that word. It feels like a sweet release when you're in these trades and it finally gives that to you. You know what I mean? I'm going to go here. We still didn't deliver the 4128 level. This is again one of those classic frustrations. But you would have a screenshot of this, and this would be like a partial, and you annotate in your chart. You want to record how much time you endured watching all of it come back down into levels that I outlined for you, that it should do certain things, certain classic characteristics that these PDA rates should do, and it should be delivering price. That's how we can know this down close candle here. And note also in your annotations how this candle here down to the low end of the fair value gap. That's perfect. See that? So high resistance liquidity runs are not exempt of precision elements that I'm teaching you. It just means that you'll have a lot of this choppiness in between them. And sometimes they'll color outside the lines like it does here or here. And that's fine, because I taught last week. It's like when you're cutting grass, or I gave you that analogy. When you're cutting grass, gentlemen, you cut through, you turn them over around, and you go overlap what you've already cut and what is uncut. It's that way you're making sure there's no seams in the line, no little mohawk toes, a little strip of grass that's still too high. That's what the market's doing here. It's overshooting the fair value gap, making sure there's no seam here. Down into this imbalance, overlaps it a little bit. That's what makes it institutional order flow. Because I mentioned I want to see this stay open before we get to here, and preferably into the consequent encouragement 1428. Then any dip down here should not be viewed. And this is very scary when you first learn. I understand. It's like most of the questions I get is how do I know? Like, how do I know to trust this not being a stop? How do I know it's not going to go through that high and take my stop loss when I'm taking a short using the 2022 model that's already 2? The fact that you're walking through this with me live right now is going to answer that at the end of the year. So for some of you, before we even get 2 or 3 months, you're going to know, oh, that makes sense now. It's experience. That's all. But because you're afraid to fail or you're lazy, you're not doing this. You want to trade. You're pushing a demo account. You're trying to get funded. You're trying to do these funded account challenges. Here's your 4128. So I'm going to screenshot that right there. And I'm going to use the shit. I'm going to later on. I hit it again, huh? But the elements of what we're seeing here are not going to be this frustrating when we're in one-sided markets. And you're going to see the difference of this versus what we're looking at now, which still can deliver your trades. I'm not saying that you can't trade these, but it's really important to understand that you're going to work harder and you're going to be worrying more. What's the upper portion? I should have a level on that. Let's go back and add that now. So between consequent encouragement of the fair value gap on 15-minute time frame on February 9th, your next objective for ES would be 41.31 even, and then there you go. For me personally, this would close my morning session. I would be done. I would close my trades. I would square everything, and I would relax the rest of the day. I'd watch some Netflix and chill, okay, or as we like to call it, chicken and fill in the blanks. Relax, enjoy your time away from the charts. Don't force yourself to be looking for another move because there's time left. Just simply because it's 10:30 and you have all the rest of the day. Don't look at that and think, I'm wasting my time by not being in these charts. No, you're pushing too hard. And you might have an edge right now that I'm helping you hone. And when I tell you to stop, close the charts and walk away. If you don't do that, you know what you're missing out on? Developing discipline and patience and overcoming what? Fear of missing out. I don't care what it's going to do the rest of the day. I don't care. Because I know what I use when I'm teaching all of you is going to repeat every single day. But I also know that there's going to be times where the markets are going to be really not favoring me to participate. And we've watched something pan out this morning. It's not about being right. Initially, if you look at what I gave last night or yesterday, I gave my pre-market analysis, what I was liking to see, or what I would have liked to see develop in price action. I mentioned that if we had a higher gap, if we got higher, that means we're probably going to do what? We're going to go up into those imbalances that we're trading into right now. Go back and look at the pre-market analysis. It's not plan A, plan B, because I don't know which one's going to be really there when we open on Sunday, and I don't know while I'm sleeping during the Monday session, Sunday night, in the Monday morning, my Monday morning. I don't know what it's going to deliver and what it's going to provide me. So when I woke up rather early this morning, I looked at it and I tweeted, yes, okay, I'm going to require 9:30 open. But going back to my pre-market analysis, what was the filter? If we have a gap higher opening, I want to see it try to trade back down towards what? Friday's closing price. We tried. We got real close to it here. The low came in at 41.01.5, but it didn't get to 49 or 40.99 something. Where is this level is here? 4099.50. So that's what I would have rather seen when you heard me talking about it live. I said, let's see if we can get down there. It didn't do it. What did it do? It ripped higher, took a run above this short-term high, and we outlined the bottom bounce here. We talked about the breaker here. We talked about how it's going to likely dig in, and then finally reach up into the 41.18 level, which it did here. Then I said 41.21.5, which it did here. Then we dig into that 15-minute fair value gap, which we did here. We're going to go to a quarter point. We failed to go here until that candle there, and then get up into constant approach. The objective I would have. But if you're holding on to a trade and not listening to me, your partial should be taken off here, and then you leave it for this here. But I would not be trading over top of ICT talking about price action. You're going to get hurt one day when I do it wrong, and I don't want you to have that experience. I want you to just simply observe, listen to me. Each one of these are a laboratory experiment. They're teaching you how you're going to feel without any knowledge, without any kind of right or wrong. Every time I'm talking to you like this, who's at risk of being wrong? I am. So it frees your mind of all of that concern. You're getting to watch me walk out here without a safety net. And I'm teaching you the very things that I've taught on that YouTube channel. I'm proving efficacy. I'm teaching you that these concepts absolutely work. I'm teaching you that there are periods when you're not going to know what the market's going to do, and that's okay. It's okay to have that moment, not knowing what it's going to do. Because if you sit around and wait for the market to tell you what it wants to do, it's like it is here. Even though this is high resistance conditions, it's still going to likely deliver to our levels, but you have to endure a whole lot more pausing, more retracements, stagnation in price action before it gets there. And that's what I really want you to focus on and annotate that in your charts for your journal today. Not saying this was a bitch to sit through, this was so hard, this was so stressful. You don't want to use those terms. You want to say things like, it was surprising to see how much time it required for the market to trade to our levels, or not my levels or our levels, to your level. You always want to talk in terms like you saw these things coming beforehand. You are absolutely lying to yourself in your journal when you're annotating your chart after the fact, but you're watching me call it live. You're borrowing my experience and you're recording like you yourself saw it and you anticipated all these things. Everything that is outlined here, you're anticipating that. That's how you're recording it. So I'm pleased that I saw this fair value gap support price and it only went down into it partially like I was expecting and it remained open. I'm satisfied that PDA rate performed as I expected it to. You see the difference what I'm doing here? Versus not wanting to journal, because the reason why 99.9% of you, I see this in my close this morning, because we've accomplished what we were trying to do. At least I'm satisfied with it. You might not be satisfied, I'm satisfied. But 99.9% of folks that are not trying to treat this as a business, when you're running a business, anyone that does business, when I was managing a Domino's Pizza, and for some of you that don't know me, I did that. I was a Domino's Pizza delivery driver, and then I managed the branch in the river, which has closed down now, doesn't exist. I actually met my wife in that same store. But you run a business with KPIs, okay? And you run your business with models that tell you this is how your costs for doing business need to stay in this range. So your cost for ingredients and your cost for overhead and hours worked. So if you know that your business is slowing down to get to that peak hour, whatever it is, you need to be able to know that, okay, this is normal fluctuations. Now we're outside the boundaries of when the highest form of volume comes in. Now we want to relax and trim our overhead, send people home, send drivers home, and then not make up so many new pizzas, right? Because they may not get sold as fast as you want them to. Well, in trading, you're going to discover with your own personal KPIs and Google KPIs. I'm not going to explain everything to you. It's a simple procedure to Google. But it provides you a baseline for you incorporated, okay? You, the person listening to me, the trader that you're trying to become, is going to be independently doing what I'm showing you here. You're a corporation, you're an enterprise, you're a Fortune 500 in the making. But you can't arrive there if you're lazy, if you're not taking consideration in how you manage yourself, how you think. You have no idea how to evaluate your baseline growth, your productivity as a student of the market, your efficiency using these tools, and how much mental capital are you spending? How much time are you worrying over these charts? And over time, you're going to see, by doing what we're doing each day here, that mental capital will not be spent as much as it is when you don't have something like this, where you have someone experience outlining what the market should do. If you don't have me, if you don't have someone else that knows what they're doing, and they've coached you and they're doing it right with you holding your hand saying, this is what should happen. It feels, I guarantee all of you felt really confident this morning. You might down deep down inside consider, it's probably wrong here, I don't know, this feels a little weird, but you feel confident because I'm talking to you. You're watching the chart live, and subconsciously you know, if I'm wrong, it didn't hurt you. You didn't make your public opinion. Well, your opinion public rather. I am. I don't know how many people are listening to me and watching me live right now. I don't want to know. Because if I have that in my head, I'm going to start running ratios of how many of you are actually pushing the button taking trades. So I don't want to do that. There's no chat in there because I'm going to shit what people are saying. I don't care what your opinion is. So you want to have that in your journal. You want to filter out all of the negative, all of the criticism. You don't want to have any opportunity for you yourself to criticize what you thought you were going to see in price when you're tape reading or when you take your live trades, which you ever decide to do so, or your demo trades. So you're recording your annotations in your chart that are very succinct. They're very specific to certain things that you were expecting, and maybe you didn't expect it while you're learning with me in these tape reading sessions. Things that you heard me say. Trust me, you did not hear everything because you're worrying about maybe the trade you pushed that you shouldn't have gotten into, or you're just looking for the other reason why I'm wrong. Because there's people here listening and watching, hoping and praying that this doesn't do what I said it's going to do, so they can go on social media and troll. I'm denying them, and I'm having a great deal of fun doing that. But you don't want to go into your annotations and not at least record the things from a perspective like you had already seen it coming. Now, why would you want to do that? Because at first consideration of that, on the face surface of that, it sounds like, well, you're being disingenuous to yourself. You're lying. That's a bad thing. No. This journal is not supposed to be shared to anybody else. So are you lying to anybody? No. Are you technically lying to yourself? Yes. But you're doing it with a purpose in mind. It's called positive self-talk. You need to understand the power of giving yourself positive suggestions. And by having a visual representation of price action, which is what you're activating in your particular activating system, you're keying up on things that I'm pointing to you real time. You may not be able to see these beforehand. You may not have understood what it was on the chart.
Low key, I'm head out of here for this. I'm gonna be back for a tape reading session for sure at Market Open. So I'm gonna end stream here, but I'll be back in the morning.